Fed's in a difficult position, but it's certainly taking a risk by lowering interest rates.
They have room to maneuver. They have room to come down some on the policy rate and still put downward pressure on inflation.
The flattening that we've seen is a bit of a buy the rumor, sell the news on the back of the Fed.
The Fed is cutting on risk management grounds into what may be the early stages of a cyclical reacceleration.
You kind of have the benefits of Fed cuts without the penalty.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, adding to all-time highs. The S&P 500 posting its 28th record of the year so far, as Nvidia is revealing some big plans to invest $100 billion in OpenAI. Investors are shaking off concerns about a very divided Federal Reserve. It's Chair Powell up next.
Yeah, he speaks later today. And the question is, will anyone listen? Does anyone care? Because ultimately what we heard yesterday from a number of Fed presidents was we're not eager about cutting rates in October. We're not eager about cutting rates aggressively. We're very worried about inflation, whether it was Beth Hammack, whether it was Raphael Bostic, or whether it was Alberto Busalam. And guess what? The market doesn't care because the market's looking to 2026 and these members have less clout in the market's eyes.
There's a lot of daylight between them and one man, Governor Myron. Governor Myron wants to get back to neutral fast. How much daylight is there between him and Chairman Powell?
There's a lot of daylight, and he says he's going to continue to dissent at every single meeting if he has to, as long as his view does not change. So basically, we have what the future will look like in 2026. Whether or not Steve Myron stays on the board after January, that remains to be seen. But his thinking, that will continue, which makes it really difficult for Jay Powell today to talk about, consensus building at the Fed. Because guess what? There's now an active debate at the Fed. There's no longer a consensus think tank, Federal Reserve.
It makes it difficult to go against this market as well. This came from Bruce Richards of Marathon Asset Management. I think the next Fed chair is going to do probably QE with a twist, and the twist is buying long-term treasuries to bring those rates down. It's going to be a bonanza looking forward, not looking back.
And that's what a lot of people have been saying, that almost 100% of the time when the Fed cuts rates, we're not in a recession. The market's up and up materially since then. And this raises this question that a lot of people have been asking on the show. When are we in a bubble? And if we're in a bubble, do you keep buying? Because ultimately bubbles tend to go up a lot longer than people think. But at what point are we overinflating asset valuations at a time where no one can see the scenario where anything can go down because everyone's spending money, central banks are cutting? It's nirvana for risk.
Hello, Nvidia. A $100 billion investment in OpenAI to help them build out and spend money on Nvidia? Is that how this works? Nvidia this morning down by 0.6%.
Wonderfully stated. There is a fear that this is incredibly circular. Essentially, Nvidia giving $100 billion to OpenAI to invest in data centers that are crafted by guess who? Nvidia. If they feel like this is a proper partnership, on one hand, you can make an argument this is just supporting an ecosystem that's going to evolve. On the other hand, how circular, how self-referential is this industry becoming if some of these big chip providers are essentially lending money to their clients to buy more chips?
Nvidia chips are basically on sale for OpenAI. New Street Research says for every $10 million Nvidia invests in OpenAI, the startup will spend $35 billion on Nvidia chips. So basically, we're going to give you this money. You have to buy our chips. You're going to get them at a discount.
We've got a lot to talk about. Coming up this hour, Keith Lerner of Truist on another major AI deal. We'll speak to George Pollack of Signum on a divided Federal Reserve, and Ed Hosseini of Columbia Threadneedle as the US pledges support for Milei's Argentina. We begin this hour with stocks reaching fresh all-time highs following Nvidia's $100 billion investment in OpenAI. Keith Lerner of Truist writing, the bull market continues to earn the benefit of doubt, aided by S&P 500 earnings at record highs. The S&P is in a longer than average period without a 5% pullback, thus vulnerable to bad news. Keith joins us now for more. Keith, welcome to the program, buddy. Let's get to it. This deal, Nvidia, a $100 billion investment in OpenAI. Are we looking at a house of cards or the real deal?
Yeah, well, first, great to be with you. I mean, it does raise a little bit of red flags longer term, but, in the short term, I don't think this really is a negative. In fact, it's a positive because it's going to float into earnings. And as you just mentioned in our write-up, I mean, the key driver of this bull market has been AI and tech, and the key driver for the overall market has been those earnings from these companies. And this isn't going to change that, at least in the near term. And then as you think about Jensen Huang and his projections for 2030, he thinks infrastructure spending is going to be 3 to 4 trillion versus about 600 billion today. So does it raise some eyebrows a little bit? Sure, but in the near term, I think this means that earnings continue to move up, and that continues to support this tech trade and the overall market.
Well, how sustainable, Keith, are those earnings? If those earnings are just off the back of some big investment from one big company?
Well, it is, to one big company, but it is also, at this point, we're also thinking that we're going to see this, broaden out. And even though these AI stocks have done really well, the infrastructure spend that I mentioned still has a ways to go. So listen, as we look at the overall market, if we overlay the tech market relative price strength to the overall market, and we overlay that with earnings, there's a very strong relationship. That relationship has shown no signs of slowing down. And ultimately, I think this spend will broaden out as well. So again, it's something that we're sticking with. We think that this, not only does the bull market deserve the benefit of the doubt, tech deserves the benefit of the doubt as well.
What would raise a red flag for you, Keith, given the fact that so many people who we've talked to say that they can't really even come up with a risk scenario that could stymie some of the gains that we've seen in big tech and the broader markets?
Well, it's what you just brought up, Lisa. Expectations are high. If you look at most things, the market has been numb to negative news. So, maybe it's something from left field, but I'm also reminded by, Peter Lynch's old quote that more money has been lost in anticipation of the correction than the correction itself. This morning you all led with the amount of new highs in the market this year, 28 new highs for the S&P. When we test that out, looking at the fourth quarter, when you've seen 25 new highs heading to that fourth quarter, the fourth quarter averages a gain of about 5%. It's up about 89% of the time. Now, that's not a guarantee, but it does tell you that momentum that we see leading up into the fourth quarter tends to continue. Does that mean we're not going to see a hiccup, something that we're not talking about to kind of give us all a gut check? We'll probably see one along the way, but I want to stick with that primary trend, especially as the economy, we think, actually moves up a little bit. We've seen the 10-year come down off the highs as well. We have the Fed cutting rates, and we also have the stimulus bill that's actually offsetting somewhat some of the tariffs. So all in all, I think it's a decent environment for risk assets.
And people thought that we'd get that gut check in September, and everyone bought that gut check, so we never had it. There is this question about also the Fed rate cuts and how much that's a supportive element to what we're seeing right now in markets. You point out that when the Fed is cutting rates, when markets are at all-time highs, stocks are higher 6 months, 12 months after that, 93% of the times. How much is this really supportive of any kind of bullish call? And even if you have some skepticism about some of the tech investments, Fed rate cuts can save it all.
Yeah. In our view, the Fed rate cuts are one factor of many. The North Star for this bull market, in our view, is still corporate earnings. If I think about this year, we're up 13, 14% with only one Fed rate cut because of technology. And if we put that $100 billion number from Nvidia and OpenAI into context, I don't think a quarter or 50 basis points changes. I think where that rate change matters the most is for some of these smaller mid-cap companies that have more floating rate debt. And as you saw in July and August, there was some rotation into that as the rate cut. So I think those rate cuts are more important for the small caps and mid caps, but less important for the mega cap tech stocks, which have a lot of cash and cash flow positive.
You've been changing your mind on small caps, especially after this summer. What exactly is it about the small caps you like? Is it just the rate story in the Federal Reserve?
Yeah, well, our big picture theme, as I mentioned, still is AI, tech, and we're still overweight growth and large caps. But where we were, really underweight small caps, we went to more of a neutral position back in August. And there's a couple different factors. One, they have underperformed by the most since 2000. They are relatively cheap. That hasn't mattered. But what has changed over the last few months is the earning trends have started to move up in a meaningful way. At the same time, we have that one big, beautiful bill that has actually some incentives for more leveraged companies and capital depreciation as well. So I think that's a positive. We also have seen huge outflows out of small caps. So I think position is somewhat light. And the technical trends have improved. So we put that all together with a little bit of sprinkling of some M&A. We don't want to be underweight the group. Is it leadership? No. But we also know that, if you have like a 1% move out of Nvidia, that's about 40 billion. That's 3 times the biggest small cap company. So we want to at least participate in that area of the market, especially if we see some bouts of rotation later this year.
You still like gold as a diversifier. They also continue to hit new record highs every single day. Do you think actually you should be going longer into gold, adding more there?
Yeah, I don't know that I'd be adding more today. We've been in gold all year long. It's up over 40%. It's having an outsized impact on portfolios. The other thing with gold that's interesting is we measure when days where stocks and bonds are down. Gold has been up more than 50% of the time this year. And if we kind of zoom out a bit, even though gold's up a lot now, you have to remember these things tend to cycle in long cycles, and gold didn't do anything for almost the last decade. So we like gold longer term. We're sticking with gold near term. On a short term basis, is it getting a little bit extended? Probably, but we think that underlying trend, central bank buying, interest rates moving down, a little bit of weakness in the dollar is all supportive of continued strength in gold over the next year.
Hey, Keith. Appreciate catching up. Thanks for the time this morning. Keith Lerner there of Truist Advisory Services on the latest moves we're seeing from Nvidia in the AI space. Do you want to fight it? This came from Tony Pasquarello of Goldman Sachs just yesterday. Do I love the positioning setup and the tactical risk reward? I don't. He goes on to say, with that said, do I think you should be stepping in front of the US mega cap tech freight train? I don't.
There's no reason to sort of say that it's going to stop anytime soon. There's no red flag. Even some of the profitability, the actual monetization of these programs, you're starting to see it percolate out, albeit at pretty small levels at this point. That said, people point to the fact, and Bespoke Investments did a great job of this, this was a dynamic back in the late 1990s as well. The internet was a real thing. It actually became transformative. But who the winners were? Well, we're not using some of the same at hotmail.com that we were back then.
We're throwing a lot at the wall at the moment, trying to find out who those winners actually are. Nvidia down in the pre-market by about 0.6%, a string of all-time highs on the S&P 500, just about unchanged so far this morning. With an update on stories worldwide with your Bloomberg brief, let's cross over to Yahara Anand for more. Hey, Yahara.
Hi, John. In a blockbuster AI deal, Nvidia is set to invest as much as $100 billion in OpenAI to support new data centers and other AI infrastructure. The agreement will help OpenAI build the data centers using Nvidia's advanced AI chips. The investment will be provided in stages with an initial $10 billion. Nvidia shares popped nearly 4% yesterday on the news to close at another record high. Meanwhile, the Trump administration has linked Tylenol to autism, urging pregnant women to avoid it. The moves come despite a lack of widely accepted scientific evidence supporting the risks. Still, the FDA recommended doctors consider minimizing the pain medication for low-grade fevers, while noting a causal relationship between autism and Tylenol has not been established. And after a brief suspension, Jimmy Kimmel Live will return tonight. ABC's parent company, Disney, says it decided to bring back the late-night show after thoughtful conversations with its host. The suspension was a response to remarks Kimmel made regarding the assassination of conservative activist Charlie Kirk. That's your Bloomberg Brief. John.
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, a divided Federal Reserve.
The appropriate Fed funds rate is in the mid-2% area, almost 2 percentage points lower than current policy.
It's important that we stay restrictive to bring inflation back down to target.
It's a lot of daylight between those two policymakers. We'll get into that next with George Pollack of Signum Global, live from New York City this morning. Good morning. Some data and an important speech for this market later on this afternoon. On the data front, 9:45 Eastern Time. Look out for the PMIs. Better than expected out of Europe, the Eurozone, driven by Germany. Let's see if we get that in the United States. This is important. Are we seeing signs of a re-acceleration stateside coming out of the summer? That's the data. Then later, it's Chairman Powell. 12:35 Eastern Time. His thoughts on monetary policy and maybe, possibly, his personal views on where we are and the division on the FOMC. Into that, the scores look like this. 3-day winning streak on the S&P 500. Can we make it day 4? Just about unchanged on the S&P. Likewise on the Nasdaq. In the bond market, we've had a 4-day run of high yields. At the front end on 2s, at the long end on 10s. That takes a pause this morning, down about a basis point on 2s and down 2 basis points on 10s. Still at the very low end of the range for the year so far, Lisa. But notable that move, ever since the Fed made that call on Wednesday, yields have been drifting higher.
Maybe people have actually been reading the commentary and giving it a little bit more credence, because other than one member, and a lot of people have pointed this out yesterday, we were talking about this, the fact that you didn't get any additional members joining that dissent for 50 was telling. Chris Waller, Mickey Bowman, they stood behind a 25 basis point rate cut, there's a signal in that.
10-year bond yields this morning down 2 basis points to about 412.73. Under surveillance this morning, a divided Federal Reserve.
We should be very cautious in removing monetary policy restriction.
The appropriate Fed funds rate is in the mid 2% area, almost 2 percentage points lower than current policy.
It's important that we stay restrictive to bring inflation back down to target. If we remove that restriction from the economy, things could start overheating again.
Leaving policy restrictive by such a large degree brings significant risks for the Fed's employment mandate.
So here's the latest this morning. Division at the Federal Reserve making itself known as traders await more Fed speak, with comments from Chair Powell expected later on today. Joining us now to discuss is Bloomberg's Mike McKee. Mike, there's a big difference at either end of the spectrum on the FOMC.
Yeah, we heard from both ends of the spectrum. Beth Hammack, Raphael Bostic, and Alberto Musalem are three of the hawkish members of the Fed. And they all spoke yesterday and all said basically the same thing you just heard from the Cleveland Fed Bank president. It's Stephen Miron who stands out, calling for much lower rates much faster, because his argument is that tariffs, taxes, and immigration have all changed the neutral rate for the U.S. economy. And it is, as you heard him say, much, much lower. There's not a lot of support for that. There are some people who think that the neutral rate has come down, but nobody's really putting a number on it like he is at this point. And I would point out, you just had a graphic showing that Mickey Bowman is speaking this morning at 9 o'clock, and she's speaking on her economic outlook. And since she's the closest one to Miron in terms of the distance between the hawks and the doves, it will be very interesting to see if she accepts any part of his argument and suggests that anybody on the board might be even close to his view of how much interest rates should come down.
Mike, can you just build on the debate around the neutral rate? Just how wide are the range of estimates currently at the Federal Reserve for precisely where neutral might be?
Well, the long-run neutral rate in the summary of economic projections is 3%. You can't really take that too seriously because everybody just kind of puts down a number there. But then when you talk to most of them think it's in that area. Of course, you can't really see what the neutral rate is. You can only observe it in hindsight, or as Jay Powell likes to say, we know it by its works. And so I think you've got big majority on the board thinking somewhere around 3, and some people think maybe 3 1/4. Some people think maybe 2.75, but nobody is saying 2 to 2.5% at this point.
Mike McKee with the latest. Mike, thank you, sir. Appreciate it. Let's run with the idea that we've got 2 different time horizons here between now and May, and then from May onwards. So that's basically the difference between a Chairman Powell Fed and Chairman Powell no longer being there. Let's deal with the next 6, 7, 8 months or so. This Federal Reserve, the last cut was the easy one. The closer you get to neutral, the more difficult it becomes. And I wonder how persuasive the Governor Miron argument's going to be for the remainder of the year and through early 26.
I thought Mike actually had a wonderful point, the idea of Beth Hammack, but then also Mickey Bowman, and how important it is to listen to how much credence she gives this argument of a neutral rate around 2% or even 2.5%. If she is amenable to that kind of idea, this could point not only to more reductions next year, but also to the Operation Twist that we've heard so much about.
To extend the conversation, George Pollack of Signum Global joins us now for more. George, welcome back to the programme. I mentioned those 2 different time horizons there. We've dealt with the first one, the remainder of Chairman Powell's tenure as the chairman of the Federal Reserve. Let's talk about the post-Powell world at the Federal Reserve. Are Governor Miron's thoughts a taste of things to come?
Yeah, I think any notion that a next nominee from President Trump will be someone not like Governor Miron, I think is optimistic thinking. The reality is the president understands, having nominated Powell in his first term, that he needs to get people who agree with his preferred monetary policy on the board, and that should be the expectation by and large.
George, do you think he's purely on loan to fill this vacancy until end of January, or is he auditioning to stay on the Fed longer?
From my perspective, it has to be an audition. There's no way in the world he does not want to be a Fed governor for the 14-year term. He is auditioning, and he understands that while he's auditioning, he has to stay in line with the president. Even if these are his true beliefs, he's going to not deviate from the president and understand that if he doesn't do well, he can either lose his position on the CEA or not be nominated for a full 14-year term.
When it comes to thinking about the next Fed chair, do you get the sense that this administration is not in a rush because the Federal Reserve is moving in the direction that the president has been asking for months?
Yeah, actually, that's been a really interesting observation to see how, 6 months ago, it was all panic about who's the next Fed chair, and the administration seemed to be moving quickly, and there was talk of, an early nominee. That seems to have slowed down, and I would imagine that's largely in part because the Fed's moving towards it. Additionally, I think the president's taking some grace in the idea that at least he has Myron on the board, being his advocate at the FOMC.
There's also a question about the reaction function on the Federal Reserve, even with any kind of new Fed chair who is more amenable to President Trump's policies. What the response is to inflation that does pick up again or remains fairly high. And I ask this not through an economic lens, but through a political lens.
And I think that's one thing where I feel that the Trump administration is kind of sounding like the Biden administration of 2024, where they were all arguing inflation is transitory. Look at the fundamental data. The economy is good. There's no way we lose this election. The Trump administration seems to be making that same exact mistake, saying, no, our policies are actually working great. There's no inflation. Immigration is good. The tariffs are good. Everything is helping. And it feels like they're sleepwalking into the midterms, just like the Biden administration and the Harris campaign sleepwalked into 2024.
This is what a number of people have argued, that people in the community are feeling inflation much more than the idea of transitory that seems to be resurrected on the Fed, but also beyond. I'm just wondering, from the polls that you see, is there real credence to this? Is there an actual feasible opposition, a collective message on the other side that actually can disrupt some of the Republican presence in the midterms? Or is this just something to watch as we head into the end of this year?
So I think that's two separate questions. We're seeing in polling that the president is underwater on the handling of the economy and that American voters really don't like the tariffs. But the separate question is whether Democrats can establish a message saying this is how tariffs are raising prices. And I think that's more difficult because the reality is tariffs are a nuanced issue. And the president has a compelling argument saying bringing back U.S. manufacturing. And I think when the voters hear U.S. manufacturing, or they hear, this is more of a tax, they kind of don't know what to believe, and they kind of just accept it and move on. That doesn't mean, though, that the president's handling of the economy is not going to cause them issues and not going to cause the Republican Party issues coming into the midterms.
George, there was a subtle sign just last week in reporting from the Washington Post that maybe Congress would begin to push back and look to provide exemptions for things like coffee. George, is that a one-off or a sign of things to come? Do you think maybe in the future we'll see a little bit more of that?
Look, I think the reality is, I know that was Don Bacon who introduced the coffee legislation. That bill's not going to pass. Speaker Johnson won't put it on the floor, and even if it gets on the floor through a discharge petition, Majority Leader Thune certainly won't consider it. And let's say on the event that maybe it passes by some miracle, the president's going to veto it, and they're not going to have the supermajority necessary to overturn the veto. So I think for that's more just messaging to the administration saying, hey, you need to work with us on this. Please tone down the temperature. But in reality, as long as Republicans are in control, I would not expect pushback. And even if Democrats are to retake the House, for example, in 2026, I would not expect a Republican Senate to take up anything restricting the president's authorities.
George, appreciate your time, your input, insight, and your opinions, sir. Thank you. George Pollack there of Signum Global. That last point there, messaging may be. I think that messaging might get a little bit more stronger in the year to come going into the midterms.
Absolutely. And you mentioned this legislation potentially on a carve out for coffee. It was not just Don Bacon. It was also Ro Khanna. It was bipartisan. What do you think constituents are saying when they see their lawmakers and they see their representative? It's probably like, why is my latte $5 more than it was years ago? You said you were going to fix it. You didn't.
George alluded to something else, which is even when the Democrats, or if the Democrats do take control, it's not likely that they're going to roll back these tariffs either, just simply because, well, he pointed to the Republican majority. My thinking is it brings in a lot of revenues. And realistically, you would see a bond market tantrum if you just cut those revenues off completely and you didn't adjust to any of the spending plans. You put that together with potentially what could happen. This actually does come down to the Fed and the Fed's response to inflation, because I don't see another way.
Well, two things. Potentially, IEPA is going to strike it down, and then we might actually be left with this shortfall. But also, you mentioned this polling on inflation. Approval on inflation, Real Clear Political polling average, 39%. 59% disapprove how they're handling inflation. And the president said himself, he won on the word what? Groceries.
So far, the bond market approves, to your point. So far, bond yields on 10s. 413. Up next on the program, we'll catch up with the OECD chief economist Alvaro Santos Pereira. Three-day winning streak on the S&P 500. Slight pullback this morning. No drama. Down about 0.05% on the S&P. On the Nasdaq 100, totally unchanged. In the bond market, ever since the Fed met on Wednesday and cut interest rates by 25 basis points, yields drifted higher for 4 consecutive sessions. This morning, pulling back just a basis point. The 2-year, 359.45, just short of 360. But that 4-day run, the longest on the front end, going back to July. Ever since August, we've just had this very powerful rally at the front end of the curve. We just gave a little bit back over the past few sessions.
And maybe it comes with the whole idea of buy the rumor, sell the news. The idea that after Jackson Hole and the speech that we heard from Jay Powell, it was clear they were prioritizing growth and protecting the labor market above curtailing inflation. That run got essentially confirmed to some degree by the Federal Reserve, but maybe not as much as people expected. Maybe we're giving that just a little bit back.
That's the rate story. Stateside, push it through foreign exchange. Euro-dollar very close to 118. Actually briefly had a stronger euro off the back of some strong data. The PMIs, Eurozone private sector growth, fastest in 16 months. That's the Eurozone PMI. Later on this morning, 945 US PMIs. I think that's an important data point. First real flavour of just how we're doing coming out of summer.
Especially given the fact that everyone's been talking about a manufacturing revival and there have been signs around that, and yet the PMIs have been still coming in below the expansionary level. Do we see a shift in that, and how much can that support the idea that we're actually entering into a reacceleration, not the opposite? That's what a lot of CEOs have been telling us.
That's what the stock market's priced for into 26. The euro against the dollar, 117.92. That's the cross-asset price action. Let's get you some single names, some morning movers. Let's cross over to Danny with more. Hey, Danny.
Hey, John. We start with a company that IPO'd just last month to a lot of fanfare. Now it's trading below its IPO price. That's Firefly Aerospace, down a whopping 10% this morning. It had earnings after the bell. Of course, it's the first set of earnings since IPOing, a wider loss than expected. The problem for them, the CEO says there's demand, but they're trying to ramp up their actual supply to deliver out. So again, those shares sinking some 10% this morning. Elsewhere in aerospace, it is a good day for Boeing. Shares are up 3.6% after the U.S. ambassador to China, David Perdue, said that there was a huge order, that was his language, coming from China to Boeing, said that the president would like it and that China would like it. That would be a big deal for the two entities. Bloomberg has been reporting that China has been working on about a 500 aircraft order from Boeing. So maybe it is that order that is sending shares higher. Meanwhile, Kenvue, it is recouping some of the loss yesterday, well on its way to do that, up 5.9% after President Trump said yesterday that pregnant women should avoid Tylenol, or the active ingredient in it, acetaminophen, that of course is made by Kenvue. There's been a reaction from researchers afterwards saying that the evidence isn't quite there. Citi writing that because of that scientific pushback and the limited judicial risk with no new evidence, they expect that Kenvue shares continue to rebound. John.
Danny, appreciate the update. That stock is up by 5.9%. More from Danny in the next hour. On our radar this morning, Nvidia set to invest up to $100 billion in OpenAI to build new data centers. The investment, provided in stages, will help power the future of artificial intelligence. Nvidia jumping nearly 4% in Monday's session. Elsewhere, world leaders in New York City, as President Donald Trump is set to address the UN General Assembly. Trump will also hold key meetings with leaders from Ukraine and the EU, plus a special summit on Gaza. And finally, all eyes will be on Fed Chair Jay Powell later today as he gives his first public speech since cutting interest rates last Wednesday. Investors will be looking for clues on the future of policy when Jay Powell speaks around 12:35 Eastern Time.
The future of policy until May of next year, perhaps. This, to me, is really the question. How much does anything he say really matter? Does he give a sense of what his personal view is? And how much are people going to be looking for a signal of the committee's pushback to Stephen Myron's views? Ultimately, is there going to be a litmus test in how convincing some of his arguments were to members on the board? We're thinking about that with Mickey Bowman. I'm also wondering whether Jay Powell is going to mention that at all today as well.
Well, what he said last week when he was Jay Powell, there are no risk-free paths. So he's likely going to say that again. He also said it's not incredibly obvious what to do. We have to keep our eye on inflation. I thought that was interesting what Myron said yesterday about inflation, indicating in the future, because they want to look like they're moving the goalpost too soon, in the future, he would be open to getting rid of that precise 2% inflation target. We could be looking at a very different Fed in 2026 and 2027.
Chairman Powell did a decent job of finding consensus last week when there probably wasn't any consensus at all. And what they all appeared to agree on was just the phrase risk management. What they all disagree on is how much risk there actually is and how you should manage it. And you're going to see that more and more in the speeches in the days to come.
Yeah, and especially if you have data that comes in better than expected, like so much of it has. How much does that kind of tie their hands too. If you start to get, for example, employment picking up, you get sort of a rebuttal of what we saw in terms of the summer weakness. Can they cut in October right now? The market is pricing in a 93% chance that they will. So a lot of room for disappointment right now priced into the Fed funds market.
Chairman Powell, 12:35. Eastern Time. Let's turn to the global economy. The OECD says the world has yet to feel the full impact of President Trump's tariff agenda. A new forecast is marking down global GDP growth to 2.9% for next year, despite a stronger than expected 2025. Joining us now to discuss is Alvaro Santos Pereira, the OECD chief economist and incoming ECB Governing Council member. Alvaro, welcome to the program, sir. Would love to get your thoughts on what's happening with the global economy, but more specifically on what's happening with Europe. The Eurozone GDP number is going to be closer to 1% than 2%. Alvaro, what is happening with the European economy, and why is the stimulus coming out of places like Germany not helping us get a better growth profile?
Well, thanks very much. Thanks for having me. Well, first of all, we expect that GDP growth in Germany will pick up and from 0.3 to about 1.1% next year. And this is because of this fiscal stimulus and the military spending that is expected. Remember, part of this fiscal stimulus has to do with infrastructure needs that Germany really needs, especially in areas of digital. And so I think it makes total sense. On the other hand, we see other parts of the European area, like France and Italy, growing relatively okay, but not spectacular. So Europe continues to grow around 1%, 1.2 this year, 1.1% next year. And so that means I believe there is more needs to be done. What can be done? I think Europe needs to improve its business climate. It needs to reform and reduce barriers to competition and barriers to entry in many sectors. And in particular, I think it's absolutely essential to what Europeans say to complete the savings and investment union. What this means is that to create the conditions that so that venture markets and more equity markets become stronger and less, and European firms become less reliant on banking financing.
Do you believe, based on the outlook for inflation, that there might be sufficient space for the ECB to provide additional support in the year to come?
Well, I think right now inflation seems to be on target, and I think it's always important to keep a buffer in terms of monetary policy, on fiscal policy as well. But I think the buffer is important because, as we saw in the last 5 or 6 years, we were hit several times with a pandemic, with a huge energy crisis, followed Russia's invasion of Ukraine, and recently the policy uncertainties around the tariffs. And with all these shocks, governments have to have some margin. Debts are very high, and we believe that it's on the fiscal side, the fiscal discipline is essential. On the other hand, on monetary policy, if you keep some buffers so that you have the room to maneuver in case of a shock, I think this is absolutely essential.
This goes to the question of whether the ECB wants to be a bit more accommodative or is open to that, or whether they want to keep their firepower. And this is important for you, not only as a chief economist of the OECD, but an incoming governing member on the ECB. And I'm just wondering how open you are to potentially cutting rates in as soon as December, something that some of your colleagues have been open to, given the lack of growth and the lack of expectation of growth at a time where inflation doesn't seem to be materially picking up.
I think, as I said, inflation seems to be in a good place right now. It's important to say that the problem of Europe, lack of growth, is more to do with the reforms that have not been done, completing the single market, and working on many other areas of simplifying regulations and being able to bring a more general competitive environment rather than on the monetary policy front.
There's been a question around how some of the European economies have dealt with debt and deficit as well. A question of how much raising taxes is the correct measure for this issue, which has raised questions about the French government debt market, among others. How are you viewing the remedies that economies like the United Kingdom are proposing to raise taxes? How are you viewing that in terms of growth versus becoming more of a problem?
Well, we know that debts are at historically high levels in many European economies, not only. And we know that spending pressures are rising. There's more spending pressures for the military. There's more spending pressures for the green transition and the energy that is needed for AI. And there's more spending pressures with the aging of the population, which means that if you start already with very high debt levels and you have all these spending pressures, something has to give. And so going back to fiscal discipline, whether countries work on the tax side or on the spending side, it's obviously a personal choice for governments and depending on the choices of a particular country. Having said that, we do think that in terms of spending, there's more that can be done in terms of spending reviews, reviewing procurement arrangements, establishing better fiscal frameworks in the medium term, so that there's margin also to do more in terms of spending. In terms of taxes, a lot of taxes do not have enough broad tax bases. There's more that can be done to reduce, to increase the tax base and reduce the rates. So I think there's margin that governments can do before they raise taxes in a significant way.
Your report says that we're going to see the tariff hit from the United States next year. But you're talking a lot when you look at Europe, how they need to think differently and enact reforms. Do you think the President Donald Trump's trade policy is forcing Europe to take major changes that actually will be good for them?
Well, I do think that Europe has to address reforms that have been postponed for a long time. Think about the single market. Europe is fantastic to produce nice reports. We just produced 2 really good ones on Letta and Draghi. But the problem that Europe has very often is that it doesn't follow through, does not implement those reforms and those reports. In particular, the single market was created in about 92. Big changes, creating a much bigger market for all Europeans. But on the other hand, there's many areas in services and transportation, in energy, in which there's not really a single market. So if concentrating on those reforms would be, for me, the priority. I think Europe needs to get its act together in terms of reforms. Of course, tariffs are a challenge, but I think the most problem in terms of Europe is the lack of reforms, and more needs to be done in that area.
Alvaro, do you see the ECB as an institution? Do you see it as their role to make sure there's sufficient discipline to push them to have an incentive to make those reforms? Do you believe that maybe some of the moves we've seen from the ECB in the last decade plus has perhaps taken some of the heat off those governments in a way that has been maybe undermined the continent and the broader economy?
Well, I think the ECB, with its studies and reports, can highlight some of the big challenges that we have going forward. For example, the aging of the population has a massive impact on our systems, tax systems and other systems. We also know that a big challenge in terms of AI. We just highlighted, in fact, in our report, big increase in digital investment in the United States compared to anywhere else, and there's not enough in Europe. What is the case? Why is this the case? And on the other hand, also in terms of the green transition, what can countries do? And so I think that the ECB and central banks have an important role to play to highlight and to study, first of all, the problems, highlight possible solutions in the future. And I think the central banks need to look also to these long-term trends that are taking place right now in the world economy, so that they are able to guarantee good monetary policy and guarantee financial stability.
Alvaro, just before you go, I wanted to squeeze in an important question. How you would characterize the balance of risk around the inflation story at the moment? Here in America, there is a focus on upside risk to inflation. In Europe, there's been a conversation about the continent potentially eating Chinese overcapacity, and those exports that would traditionally go to America to go to Europe and to other places. And the team here at Bloomberg's done a great job today of just breaking down how much we've seen an increase of exports from China to various regions. Do you see the tariff shock of the last year as potentially a disinflationary shock for the Europeans?
Well, the tariff shock is bringing more inflationary pressures in many countries. And we expect that many of these the tariffs, the effects of these tariffs have not been fully impacted in the economy. We have a graph that shows exactly what's the effective U.S. tariff rate and what is right now the current tariff rate in terms of the customs duties. And there's still a divergence between the two. What this means is that there's still a few inflationary pressures that will have to be embedded into the economy and will be incorporated by firms in the next few months. So we expect that there will be additional price impacts for firms, not only in the United States, but other parts of the world too. So I do think that the overall picture is one in which you have additional inflationary pressures from tariffs. And on the other hand, we have, even though service price inflation has been very sticky around the world, goods price inflation started to tick up a little bit, in particular in countries like Japan and a few others. Food price inflation went up quite significantly, and this is adding additional pressures on goods price inflation. So it's very possible, if this continues, that there'll be additional pressures and additional risks regarding goods price inflation in the foreseeable future.
Alvaro, appreciate your time. Thank you, sir. Thanks for making time for us this morning. Alvaro Santos Pereira there of the OECD. Let's give you an update on stories worldwide with your Bloomberg Brief. Let's cross over to Yahara Anand for more. Hey, Yahara.
Hi, John. Hong Kong has issued its third highest storm warning as Super Typhoon Ragasa approaches after lashing the Philippines, which you can see there in that video. It is equivalent to a Category 4 hurricane, according to the local weather agency, and has caused major flight disruptions, closed schools, and businesses. It could potentially be the most damaging storm in the region since 2018. Meanwhile, here, President Trump is set to meet with Democratic leaders this week to discuss a funding bill as a shutdown looms in Washington. House Minority Leader Hakeem Jeffries and Senate Minority Leader Chuck Schumer requested to have the meeting with the president ahead of the September 30th government shutdown deadline. And in an interview with Times of India, JP Morgan CEO Jamie Dimon says he hopes President Trump and Indian Prime Minister Narendra Modi can reach a trade deal. Plus, when asked about the Trump administration's steep hike on H-1B visa fees, Dimon said he will be engaging with stakeholders and policymakers, adding that the move, quote, came out of the blue. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next, backstopping Argentina.
China has a foreign exchange swap with Argentina. Would you consider a credit line directly from the United States?
That's not under consideration.
Ed Hosseini of Columbia Threadneedle joins us next, live from New York City. This is Bloomberg. Live from New York City, welcome to the program. Under surveillance this morning, backstopping Argentina. Here's the latest. President Donald Trump gearing up for a meeting with Argentina's President Milei today as the U.S. is pledging, quote, large and forceful action to support Argentina's economy. Ed Hosseini of Columbia Threadneedle writing, it is difficult to make the case that Argentina is a systemically important economy. All economic interventions in Argentina over the past half century have failed. Ed joins us now for more. Ed, good morning. Good to see you.
Good morning.
Let's just sit on that point. Why do they keep failing? What is it about Argentina and the way it's set up politically that ends up looking like this all the time?
You know, it's an incredibly difficult mix and an incredibly difficult history, and they haven't really broken loose of some of the policy mistakes made back in the 80s to this day. And it's not clear if there's a path forward to do that.
There was one recent election that pushed back against Milei. Up until then, it felt like the market was very happy and comfortable with the reforms and some of his policies. Are we voting down his policies or voting down the individuals that might be coming through? What's this market actually responding to?
Again, it's incredibly difficult. Almost every election in Argentina, when they have an election, tends to be a change election. People are quite uncomfortable with the pace of change, with the sacrifices necessary for that change. Poverty in Argentina is in the 40s. And what markets are starting to get nervous about at the moment is the return of the previous administration, which was a lot less market-friendly, a lot more focused on state intervention, and quite negative for the currency.
Would you say that Argentina is uninvestable, even with any kind of initiative from the U.S. government, just simply because it's already defaulted 9 times on its sovereign debt going back in its history?
I mean, this is super tricky. Argentina is investable at the right price. And the difficult environment that they are in at the moment from an investment perspective is their bonds have priced in their hard currency, the dollar bonds, had priced in a lot of good news just a month ago and have been going through a shock. Faith in Milei's ability to carry on the reform program is fading. Faith in the currency stability program is fading, which means they're losing dollars to support that program. And that ultimately translates into an inability to repay their debt. And so that's the dynamic we're in right now. At the moment, it's very difficult to invest in that debt. But there will be a time when it will be once again attractive.
Well, let's broaden out this idea of, can the U.S. government pick winners and losers? How much does that really change the investment landscape for you when you're looking for developed markets to invest in at a time where a lot of people are saying a rate-cutting cycle around the world, positive typically for these economies? How much does that distort where you're willing to look?
You know, from a credit perspective, these intervention programs, particularly IMF programs, tend to be very important backstops. One, they provide dollar liquidity, which the U.S. government looks set to do here. And two, most importantly, they provide a straitjacket in terms of policy settings. To the extent that Argentina needs fiscal reform, they need currency reform. The ability of the IMF, in particular, to impose that is very powerful. I think, unfortunately, in Argentina's case, that history is very murky. There's a lot of failures in that history over the course of the past 50 years. And again, they are in an IMF program currently. They've borrowed well in excess of $100 billion from the IMF over the past decade. Will this particular intervention lead to success long term? Probably not. But in the short term, it definitely helps.
In the short term, could it change political concerns around the October 26th election in Argentina?
Probably not. The short-term fix here is the currency is under depreciation pressure. And so they need dollars to defend that currency. Markets have a way of sniffing out that support as being temporary and overcoming it. And so it's very likely that the currency will remain under pressure for the foreseeable future until that election is done, until markets get a view of what policy looks like in the coming years.
So what's in it for the U.S. if they're not going to get this win potentially for Milei in October? Doesn't this put them in a very vulnerable position?
It's an extraordinarily difficult question. I think a lot depends on how this program is designed. The Treasury's Exchange Stabilization Fund usually works through the IMF or in tandem with the IMF. It's rarely used on its own. If this is part of an expanded IMF package, it might provide a little bit of support. It might provide a little bit of fiscal room for the government heading into this election. But the election's in October. There's not enough time to change that dynamic at this stage.
Is this a broader EM problem or just an Argentina problem? Because hopes for EM more broadly have picked up quite recently.
This is, I think, a distinct Argentina problem. One of the fantastic things about EM and these developing economies since the Asian financial crisis really has been a lack of crisis. Crises have become exceedingly rare. Financial crises are exceedingly rare. They run policies that are a lot more sophisticated in terms of monetary and fiscal policy. It's a much more credible group of policymakers in charge of these economies at the moment versus where we were, let's say, in the late 90s.
This story at the epicenter of meetings taking place here in New York City this week. Milei meeting the president, Donald Trump.
I wonder what parameters there are on any kind of support lines that the U.S. gives Argentina in terms of those straitjackets that Ed was talking about on policy. That, I think, is something to watch out for.
Ed, it's good to see you. Thanks for dropping by.
Thank you.
And discussing this topic. Thank you. Ed Al-Husseini there of Columbia Threadneedle. Coming up next, Lisa Shannon of Morgan Stanley, the former U.S. Deputy Treasury Secretary Wally Adeyemo, the EDP CEO Miguel Stilwell Dondrad, and Kristen Bitterly of Citi Global Wealth from New York City. The second hour of Bloomberg Surveillance up next.
There is this hopefulness in equity markets that we are going to get through all the risks.
We're not back to U.S. exceptionalism, but there is some demand coming back.
We're seeing more signs of corporate confidence.
I feel pretty comfortable with where we are now.
If you look past this year into next year, we do see earnings improving. We don't see significant catalysts for destabilizing.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P 500 shaping up as follows. On the S&P, down by not even 0.1% following 3 days of gains on the S&P and a 28th all-time high. In the bond market, 4 days, of higher bond yields at the front end and the long end on 2s and 10s. This morning, we're back away. We're down a basis point on a 2-year at 359.24. Shaping the outlook for this particular bond for this particular session is going to be this man right here, Chairman Powell, speaking later on this afternoon around 12:35 Eastern Time. That's the address to watch on a week full of Fed speak.
Yeah, how much does he really push back against some of what we were hearing in terms of how much the Fed could potentially cut in the next 6 to 12 months? How much does it matter? What does the market actually believe, given the fact that he's going to be out in May? I think there's a bigger question underpinning his speech and underpinning all Fed rhetoric right now, which is how much do Fed rate cuts matter in supporting record high after record high? Is it independent of that expected rate cut path, or is it predicated on that? And that I think we have to answer.
And I also wonder if Chair Powell is going to maybe, at least on the margins, challenge what we heard from Steve Myron when it comes to how deep they need to cut and how fast and how different you basically have. Almost it feels like two different heads of a Fed. Steve Myron probably is not going to be the Fed chair, but he certainly represents the direction of travel of 2025 and 2026.
Everyone seems to be comfortable with where policy's at, and they're looking for a better 26, and they're chasing this market. Alexandra Semenova of Bloomberg putting this piece together today. The record-setting advance has pushed the S&P nearly 3% above the average year-end forecast of those tracked by Bloomberg, which currently stands at 6,486. Only in 24 and 99 have the calls lagged the market's actual return so much around this time of the year.
So if you wanted to know why a number of Wall Street banks, I'm not going to name names, have rejiggered their year-end forecast 4, 5, 6, 7 times, it is because of this. They keep getting left in the dust by how quickly the market is going up, which raises question, is there anything that could torpedo this Teflon market, or is this essentially immune to any shocks based on tech spending and based on rate cuts?
When it comes to tech spending, though, you both mentioned at the top of the last hour, this circular environment we have, it's a self-fulfilling prophecy right now, it feels like, in the AI world, which is bleeding into the financial markets. Nvidia giving OpenAI an investment to what? Just send it back to them, buy chips. Basically, you're just going to get a little bit of a discount.
So Nvidia rallies, and that's exactly what we saw in yesterday's session this morning, down by about 0.8%. Coming up this hour, Lisa Shallard of Morgan Stanley. With Wall Street on a record run, we'll catch up with the EDP CEO, Miguel Stilwell Dondrade, as the U.S. energy costs jump on AI demand. Plus, we'll catch up with Kristen Bidley of Citi as a newly minted Fed governor calls for bigger rate cuts. We begin this hour with stocks near record highs, following Nvidia's $100 billion investment in OpenAI. Lisa Shallard of Morgan Stanley writing, U.S. equities are increasingly pricing perfection, based largely on assumptions around Gen AI spending. With valuations rich, room for disappointment is very limited. Lisa joins us now for more. Lisa, good morning.
Good morning, Garth.
I know you don't typically do single names, but can we just pick out that deal in the last 24 hours? A $100 billion investment from Nvidia into OpenAI. Some people scratching their heads and saying, is this just a house of cards, or is this just the beginning and you shouldn't fight it? How do you approach this situation?
Yeah, so it won't surprise you or many viewers who know we typically are a little bit more cautious, that we view this with a little bit of skepticism. You know, it's very interesting when Nvidia did the spinoff of CoreWeave, which is, you know, kind of a data center operator. We felt like this was a little bit of a way of, you know, we don't want people to start asking questions about whether we're selling to ourselves or whether it's arm's length. There's something about this that is starting to smell very 99, 2000. And so, you know, look, the market right now, I think, is running on the sentiment. It's running on the fumes. It's very hard to stand in front of that. And I think that, you know, sometimes the bull case is the lack of a credible bear case. And I think that's where we are at this very minute. But the skepticism, for me at least, is growing. And so our response to that is to try to invest a little bit away from the epicenter, right, and to diversify away from that Mag 7 and say, yeah, we know that they're the epicenter, but they're probably over-owned and a little sizzly.
Well, let's stay on the bull case for now. And I think you understand it well. Cyclical recovery, pick up re-acceleration in 26, driven by this monster CapEx boom. What is it about that, the fundamental pieces of the bull case, that don't sit well with you?
So I think fundamentally, when we look at this CapEx boom thesis, a lot of folks think that somehow this just began and was ignited by, you know, our recently passed tax bill. Our thesis has been we've been in a CapEx boom, quite frankly, since the government ignited spending after COVID. So we had the infrastructure bill, we had Inflation Reduction Act, and so we've had a CapEx boom in the United States. Our best guess is we're actually in year 4 of this. And so if you look at Mag 7 CapEx spending, it has massively accelerated since 2022, but it began in 2022. And that's one of the reasons that earnings actually tanked in 2022 is those huge negative free cash flow. And we're approaching negative free cash flow amongst growth, negative free cash flow growth, I should say, among that cohort. So our belief is we're a lot closer to the 6th or 7th inning than the 2nd inning on this CapEx spending boom.
You said something that I had to write down because I thought it was so good. Sometimes the bull case is the absence of a bear case. And this raises the question of what the main risk here is. Is it potentially missing out on the upside, as John has laid out for many times before, the career risk of not getting that rally and not capturing it? Or is there actual true downside that you see potentially emerging from what does feel like it's getting into the later stage of the cycle?
Look, I think we do think that the return profile of this market is completely asymmetric, and you could easily see this market pull back into a 20% technical bear market simply if earnings miss. Right now, so much is hinged on this idea of accelerating earnings, of operating leverage, of expanding margins next year, and that we're going to get this 13 to 14% earnings growth in an economy that may only be doing 4 or 5% nominal top line. That's a lot of operating leverage. And so, we think that this is, as I said, priced to perfection. And so earnings misses, I think, are really the thing that could get people's attention here. We know that the news headlines have not been the source of catalysts of late.
Which points to a potential protection in portfolios. It's been gold more than anything else.
Yes.
It hasn't been necessarily long-term bonds, although increasingly people are starting to nibble on that. How do you see the relationship between monetary policy, the rates backdrop, and any potential pullback in the S&P 500?
Look, whenever you have a real sudden pullback in stocks, bonds do work. They really do work as a diversifier. People do immediately rotate in portfolios. And I think that they will continue to play that role. But not having that obvious catalyst in front of us, we like real assets better as a diversifier. So we are talking about gold in the intermediate term. We are talking about REITs. We are talking about commodities. We are talking about energy infrastructure assets as maybe a better diversifier in the intermediate term than long bonds.
You said news headlines have not been catalysts of late. Do you think the markets have really started to understand the president and the direction of travel, where he's going, as opposed to earlier in the year when every other word out of individuals' mouths was we're concerned about policy uncertainty?
So based on my conversations with investors and clients, I don't think it's a question of investors deeply understanding the direction of the president. I think it's investors deeply, dismissing it and saying, I'm looking through all of this, and I'm looking through all of it because there's a good portion of it that ultimately may not be fully implementable because it will be challenged in court, or I'm looking through all of this because, there's even odds that sometime in the next 3 months it'll be pivoted and reversed. And so there's almost a cynicism, I think, about the headlines. I'm not encountering a lot of deep analytic thought about, oh, goodness, I read those headlines and I know exactly what's going on. I'm changing my forecast for this, that, or the other thing.
Is there something, though, in the policy sphere that would give investors pause and not want to just look through the rhetoric out of Washington?
Again, I think it's how policy is playing through to actual results. One of the things that's given the market, I think, confidence to say things like tariffs don't matter, or immigration doesn't matter, or some of these other things don't matter, is it hasn't really shown up in a big way in the numbers. And I think if, in fact, it does, and that's what we're looking for. We're looking for next year where those earnings disappointments come from. They come from the fact that companies actually can't make the margins because they actually are eating the tariffs. I mean, the money that's coming into the Treasury on tariff revenue is coming from somewhere, right? And we're going to have to ultimately attribute it. And I think that thus far it's been absorbed by a good portion of small and mid-cap companies and their margins. And I think ultimately, as we get into 2026 and you fully realize what is a six-fold increase, right, from an effective tariff rate of 3 to a likely effective final tariff rate of somewhere around 18, that's gonna hit margins, at least in a couple of those manufactured goods sectors.
Lisa, can we just finish with how you describe conversations with clients at the moment, and what would be the more dominant sentiment? Is it an anxiety to get out or a fear of missing out? What's the more dominant sense of things at the moment?
Yes, so right now it's about getting out. I think we're having a lot of meetings with clients who now have been extraordinarily pleasantly surprised at where they are. Here they are. It's September. They're up 14%. They thought, oh my goodness, maybe nothing. Certainly back in March, they were underwater. And there's a lot of folks saying, what should we be looking for? How do I know when? Of course, our job is to keep people in the markets and discourage market timing. But I think there's a lot more anxiety building among folks in the market saying, oof, this is feeling a little bubbly to me. Gosh, the market's going up every single day.
Trying to work out if that's bullish or bearish now after hearing that.
Yeah, exactly.
Honestly, the fact that there's skepticism makes me think this can go on for a lot longer. So I don't know that this is exactly something to say.
Yes, this is not the catalyst.
No.
This is not it.
Lisa, appreciate your thoughts, as
Absolutely.
always.
Thank
Good to touch
you.
base with you. Thank you. Lisa Shallett there of Morgan Stanley. Let's give you an update on stories worldwide with your Bloomberg Brief. Let's cross over to Yahara Anand. Hey, Yahara.
Hi, John. In a blockbuster AI deal, Nvidia is set to invest as much as $100 billion in OpenAI to support new data centers and other AI infrastructure. The agreement will help OpenAI build the data centers using Nvidia's advanced AI chips. The investment will be provided in stages with an initial $10 billion. Nvidia shares popped nearly 4% yesterday on the news to close at another record high. Meanwhile, the White House is banning the Iranian delegation in New York here for the UN General Assembly from shopping at wholesale clubs like Costco or buying luxury goods. The State Department saying it will not allow Iranian elites to, quote, have a shopping spree. The delegation's movements are also restricted while they're in town. And Spirit Airlines is cutting flights and placing about 1/3 of its flight attendants on furlough. The budget carrier has filed for bankruptcy twice this year, and the cuts are part of a restructuring and cost reduction plan. And pilots could be the next group to see cuts. Spirit saying it wants to find $100 million in cost savings from pilots. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next on the program, President Trump returning to the UN.
At the center of our vision for national renewal is an ambitious campaign to reform international trade. I will never fail to defend America's interests.
A conversation up next with the former U.S. Deputy Treasury Secretary Wally Adeyemo from New York City this morning. Good morning. Live from New York City, welcome to the program. Equity futures on the S&P shaping up as follows, following 3 days of gains on the benchmark stateside and another all-time high. We're down 0.1% on the S&P. On the Nasdaq, we're down by 0.1% also. Moments ago, Morgan Stanley's Lisa Shallett describing things at the moment as maybe a little too sizzly, getting close to the 99 type kind of stuff that she was thinking about.
She said we're one bad earnings report away from potentially even a 20% pullback just because everyone's loaded on one side. At the same time, you asked her, what did clients say to her? They talk about getting out, which makes me think this probably has more room to run. It doesn't seem like this is exactly a runaway train with no skepticism.
More anxiety to fuel the fire, maybe. I don't know. Nasdaq futures this morning down about 0.1%. Under surveillance this morning, President Trump returning to the UN.
At the center of our vision for national renewal is an ambitious campaign to reform international trade. The American people are absolutely committed to restoring balance to our relationship with China. I have made very clear I will not accept a bad deal for the American people. I will never fail to defend America's interests.
So here's the latest this morning. President Donald Trump speaking to the UN General Assembly at 10:30 a.m. Eastern Time. The president addressing the group of world leaders for the first time of his second term. Bloomberg's Tyler Kendall joins us now for more. Tyler, good morning.
Hey, John, good morning. There's a few different threads that we're following on the policy front when it comes to this speech. Of course, two conflicts expected to take center stage. One, the war with Ukraine, as President Trump is set to meet today on the sidelines with Ukrainian President Zelensky, and our allies are urging this White House to commit to firmer security guarantees. And the second, the war between Hamas and Israel, as several U.S. allies have moved to recognize an independent Palestinian state in recent days. We are expecting President Trump to use this speech to defend Israel's right to defend itself. I'll also quickly mention that domestic politics will probably make their way into the president's remarks. The White House previewing it to us here at Bloomberg that he will call on other countries to tighten their asylum restrictions, ultimately in a bid to try to curb immigration in the long run to the U.S. But John, for context, hovering over this backdrop, the context that President Trump is speaking against is that the U.S. has been the largest financial backer to the United Nations, and President Trump has made clear he doesn't feel that the organization has been serving the U.S.'s purpose. In fact, the U.S. has actually stopped paying its bills completely to the United Nations since January when President Trump took office. Combine that with prior delinquencies from other administrations, and the U.S. is currently on the hook for $3 billion in dues to the United Nations. Our analysts at Bloomberg Economics do point out, though, John, that either way, with or without the U.S., the UN is in trouble. The Secretary General in January had declared a liquidity crisis, and it's currently trying to cut about a fifth of its staff.
Tyler Kendall with the latest here in New York. Tyler, thank you. Joining us around the table, the former Deputy Treasury Secretary, Wally Adeyemo. Wally, good to see you, sir.
It's great to see you as well.
You co-authored a piece recently in Foreign Affairs, the title of which reads as follows: "The world economy was already broken, but there is a better way to fix it." Can we address the broken piece first? What's broken about it? What was broken already?
At the core of what was broken was China's use of anti-competitive behavior to manipulate the global trading system. And this is exactly what needs to be addressed. And I think President Trump has a choice. He can try and do what former presidents, including himself, have done, which is negotiate a bilateral deal with the Chinese, or he can work together with our allies and partners to put together a set of policies that will hold China accountable and lower tariffs on each other. And I think that's the choice that the president faces at the moment.
John mentioned this earlier, and you mentioned it in your piece about China basically dumping on other markets, especially since the barrier of entry has gone up so high in the United States. Isn't that going to force countries like what Mexico is attempting to do, force countries to take on China themselves and basically do what you're saying, a collective unity against China?
I do think that gives the president an opportunity, because if you're in Southeast Asia today, you're in Europe today, you're seeing Chinese overcapacity wash over your shores, ruining your manufacturing sector. And the question is, what can you do? And alone, it's hard for them to stand up to China. But working together with a large ally like the United States is possible. But ultimately, the thing that I found with all of these countries is that they move when there's a leader, and the United States needs to be that leader. So if the president calls on them to work together to hold China accountable, I think it's possible. But left to their own devices, it's really hard to stand up to a big country like China or the United States.
But the Biden administration tried a multilateral approach, and it didn't work.
I think the difference now is that the president has changed the global trading system by putting tariffs in place that have reordered things. And while it's created a lot of challenges, including headwinds here for consumers and for the economy, it now creates an opportunity because something new has to happen. And that's what we talk about in the piece, that ultimately now the president has the opportunity to either say that we can all work together to make sure that China's anti-competitive behavior stops, or we can try and negotiate with China unilaterally. The unilateral approach hasn't worked in the past.
At this point, though, how do you work together with other countries when everyone is skeptical of one another, and essentially you're forcing them to take a side? Because ultimately, a lot of countries, as you mentioned, are scared of China just as much as they're scared of the United States.
I think you're right. There's a great deal of skepticism out there. But when you look at the global economy, it's still concentrated in the hands of countries that should be our closest allies, the G7, make up almost 50% of the global economy. If we were to act together, only the G7, it would be a large enough bloc to put real pressure on the Chinese. So we're calling for the president to start with the countries that we're closest with. And ultimately, the goal has to be that we create an economy that not only works better for the United States, which it should, but works better for other economies also, because the more trade that you do, if you're a country, the less aid you're going to need in the future. So the key now for the president is to talk to these countries who ultimately need the United States, frankly, because we are one of their biggest consumers in the world, to try and work with them to put pressure on the Chinese, because the unilateral approach, previously at least, hasn't worked.
I just am wondering how much the world order has already changed and already shifted away from the United States being able to play the role in the way that it could have even a couple of years ago. The idea, for example, of the Ukraine-Russia war and the repatriation potentially of some of the holdings and how much that's shifted foreign currencies, foreign governments to buy gold and diversify away from the dollar. Is it too late?
I think everybody always says that, but in 2022, I was looking at what should we do with regard to Russia when they were thinking about invading Ukraine, and the Russians had moved a bunch of their assets, but more than 88% of Russian bank transactions on one side was still the dollar. It's really hard to get away from the U.S. economy. We are the biggest economy in the world. We're the biggest trading economy. And while that is shifting over time, I think this is the moment for us to try and make sure that we build a system that works better for us going future. If we wait too long, and we say this in the piece, China's use of anti-competitive behavior will fundamentally have changed the global economy in a way that will make it harder for the U.S. to win going forward. And not just the U.S., but for other economies as well. That's why what we do over the next few years is critical.
While you've been in the room, the president truths a lot about how annoyed he is with Europe that they continuously buy Russian fossil fuels. It's been very hard for them to really divest away. How difficult it is to deal with the Europeans?
It is hard, but I think the U.S. has a lot of leverage here, especially over one of the countries that's doing this, Hungary, who's a big purchaser. And I think fundamentally one of the things we've got to do is work with Europe to both end their purchases of Russian energy. We did a lot to do that in terms of providing Europe with LNG to replace Russian energy. But we've also got to take actions, not only against India, but against China, who's a huge purchaser, but also a huge seller of the goods to Russia that they need to build the weapons they want for this war in Ukraine.
These stats on Chinese exports are just phenomenal. This came from the newsroom this morning. On track for a record $1.2 trillion trade surplus coming out of China. And if you look at the exports to India, record high in August. Shipments to Africa on track for an annual record. To Southeast Asia exceeded their pre-pandemic era peak. Just figure that out. We're talking about massive numbers of Chinese product that's just being now dumped on the rest of the world. And you're going to find out whether they'll come along for the US or not for the ride, because it's really important. You said Mexico. I wonder how many people follow Mexico.
Yeah, and I'm wondering about, for example, European auto manufacturers, considering how many electric vehicles China has been offloading to Europe. On the flip side, it hasn't been supporting the Chinese economy. They've been in a deflationary spiral. There's a lot of questions about how much these are unprofitable goods. There are a lot of questions economically that are underpinning this as well.
Wally, it's good to see you.
Great
as
to
always.
see you too.
Always diplomatic. Thank you, sir. Wally Adeyemo there, the former Deputy Treasury Secretary. Up next on the programme, Miguel Stilwell Dondrad, the CEO of EDP, on the race to power artificial intelligence. Plus, Danny has your morning movers. AutoZone shares falling following their latest earnings. That stock is down 2%. The president speaking later on this morning, a preview of that speech coming from the press secretary Caroline Levitt just moments ago. President Donald Trump will highlight the return of American strength during a speech at the UN General Assembly while delivering blunt and tough talk about the failures of globalism. All of that still to come in the next few hours.
Yeah, the president's set to take the stage at 9:50. We're probably going to hear a little bit of what Trump said back in his first administration when it comes to the United Nations, but also going against the globalists, kind of what he said likely when you and Lisa were at Davos earlier this year, and basically talking about how, at least in America, they've rejected that world order for now.
Back in the day, 2019, in the first term, there would be people in the audience sneering at the president as he made these points about what the Europeans needed to do to change. He'd talk about European energy, the relationship with Russia. I don't sense the same sneering this time around. Many years later.
There's a different landscape, and I think that there is a greater rejection of some of the old norms. I think we're in a new normal, and the question is how that's going to get rejiggered and exactly what kind of leadership is going to be provided for that next phase.
That's the policy talk coming up later on this morning. In the market at the moment, equity futures pulling back by just 0.1% on the S&P following 3 Days of gains on the S&P 500. On the Nasdaq, down by just 0.06. In the bond market, 4 consecutive days of high yields. Following the Federal Reserve decision last Wednesday to reduce interest rates, this morning we pulled back by just a basis point on 2s. Likewise on 10s. We're down to 412.93 going into Chairman Powell later on this afternoon.
How much does this really become the new stasis as people try to understand exactly what the balance of opinions is on the Federal Reserve? I think the big question, not just for Jay Powell, but for some of the other speakers is, particularly Mickey Bowman, who speaks in about an hour and a half, how much do they push back against the view of the world that we heard from Stephen Myron, and how much do they embrace this idea that the neutral rate could be significantly lower?
Chairman Powell at 12:30 Eastern Time. As we count you down to the opening bell, about 2 hours away. Let's get you some morning movers. With more, here's Danny. Hey, Danny.
Hey, John. Boeing shares are moving higher this morning by more than 2%, with the U.S. ambassador to China, David Perdue, saying that there was a huge order in the works from China to Boeing, saying that it would be a big deal for the president and a big deal for China. Bloomberg did report last month that China was working on finalizing an order of about 500 aircrafts from Boeing, so that could be this deal. Again, with shares rising this morning. Elsewhere, Kenvue making the work to snap back some of the losses it had yesterday. Shares are up just under 5%. They fell yesterday after President Trump said that pregnant women should avoid the active ingredient in Kenvue's Tylenol, which is acetaminophen, but there has been a little bit of pushback from the research community. Citi, for example, saying that no new scientific evidence was offered and there is limited judicial risk from the announcement, so they expect shares to come back. Finally, a little bit of earnings this morning. AutoZone reporting they did beat on their comparable sales. Net sales, though, that was a miss. And notably for them, margins were a miss. And maybe even more notably, they had a really, really big inventory buildup. It was 14% higher than at this time last year. That far exceeded analyst estimates. Just shows you for these companies that are having to import parts, how difficult it is to grasp the inventory picture and how much they should hold. So those shares down more than 2%, John.
Danny, thank you. Appreciate the update. More from Danny in the next hour. On our radar this morning, Nvidia investing $100 billion in OpenAI to expand the fleet of data centers that power ChatGPT. The Nvidia CEO, Jensen Huang, saying it will be the biggest AI infrastructure project in history. Elsewhere, U.S. Treasury Secretary Scott Bessent pledging support to President Javier Milei to keep Argentina from falling back into financial crisis. The announcement calming investors and prompting a rebound in Argentina's assets. And finally, President Donald Trump talking with Democratic leaders as soon as this week about a funding bill. House Minority Leader Hakeem Jeffries and Senate Minority Leader Chuck Schumer requesting the meeting ahead of the September 30th shutdown deadline.
What's interesting about this is that you have these 3 New Yorkers getting in the Oval Office. Maybe they can hash out a deal. But it remains unclear whether the Speaker, Mike Johnson, and the Senate Majority Leader, John Thune, will be there to represent their case in Congress. We're a week out from the government shutting down. Or will Trump be left almost to his own devices to try to go into this, to negotiate with the Democrats himself from the executive branch?
I'm old enough to remember when people used to care about government shutdowns. Right now, there's almost a 70% chance baked into some of the prediction markets that the government will shut down. It's almost expected that there will be some sort of shutdown. And people are saying, well, unless it goes on for a month, 2 months, 3 months, unless we're 6 months out and we don't have a government, then we'll start to care. I mean, it just highlights how policy insensitive this market has become. And I think that that is a notable takeaway from this.
The shutdown is a political event and not a market event. And we've all been conditioned by experience to believe that. That's what we've lived. Why would that change anytime soon?
Well, if it carries on for long enough, there is actual financial repercussions to this. And potentially they're even greater should there be a rejiggering of some of the power lines. But, you know, I'll go with that. Maybe there's nothing.
There we go. Let's move on and talk about a different kind of power line. Let's turn back to AI. Nvidia pledging to invest $100 billion in OpenAI to help build new data centers. According to the Energy Information Administration, U.S. electricity prices are up 10% from January to May of this year, due in part to massive spending and high demand. Miguel Stilwell d'Andrade is the CEO of EDP, one of Europe's biggest wind energy developers, with projects also in the U.S. Miguel joins us now for more this morning here in New York. Miguel, welcome to New York. It's good to see you.
Thank you. It's a pleasure to be here.
Thank you for being here. Let's talk about the US market. Your outlook now compared to where it was maybe 5 months ago. How have things changed?
Well, I think the situation has become much more stable. I think there was a lot of uncertainty, certainly at the beginning of the year in terms of the policies. And so I think now we have at least visibility with the big, beautiful bill and also with some of the guidance from the IRS in terms of the growth for the next couple of years in renewables in general. So solar, batteries, wind, And as you know, we have 10 gigawatts here, over $20 billion invested in the U.S. So I think things are more stable, and that gives us, some optimism for the future.
Do you need a partnership with the White House for this to work?
I think we need a stable framework, a stable legislative framework to be able to invest, and I think that's what we're looking for.
And so you feel like that it has been sufficient, even with some of the pushback from the White House about wind turbines. We think that President Trump doesn't like them, right? He thinks that they're ugly, and he doesn't like them near his golf courses. I mean, how much does that really affect?
And they're bad for the birds.
How much does that affect your investment plans?
So I think it's important that, we're agnostic in relation to technologies. We invest in wind and solar and batteries. We also have gas turbines, certainly back in Europe. What I think is important is to have competitive energy, cheap, reliable, and that it should be, if possible, not have any emissions. And so that's what we're aiming for. I think wind is a perfectly good technology. It's very mature. It's being rolled out sort of across the US and across big parts of the world. And it provides clean energy at competitive prices. And it helps a lot of the landowners. I mean, some of our biggest advocates are actually the people that we work with on the ground in the local communities, because for a lot of the farmers, this is another source of revenue that they can get from these projects.
We've talked a lot about the energy needed to power artificial intelligence and some of the hopes and dreams of some of the big tech players that have been fueling a lot of the market rally. I just wonder how much of a deficit there is in power generation right now versus the hopes and dreams of the Nvidias, the OpenAIs, the Microsofts, the Googles.
I think it's relatively well known that one of the biggest obstacles to rolling out AI is access to power. And certainly here in the US, although that's also true in other parts of the world. So we're seeing huge demand. And I think going back to, in terms of technologies, what are the technologies that are available to supply that power? I mean, no one is building any new coal power plants. Maybe you can extend them a little bit longer. Nuclear, you might like it, but it's going to take time, quite a lot of time, to be able to actually implement it. Gas turbines take relatively long still to get them implemented. So actually the projects that are most available to actually be implemented in the short, medium term are actually renewable projects. Solar, wind, batteries, all of those. If it's cheap, if it's competitive, if it's secure, use it.
We've heard a lot about deregulation from this administration. Are they actually cutting the red tape to take on projects like this in an accelerated fashion?
So we're still seeing some bottlenecks. It's not particularly true of this administration. I think we've been advocating for quite a while that we should accelerate all the permitting and licensing. Access to the network, for example, is super critical in a lot of the key markets in the US. This is something that affects infrastructure projects, I think, in general. And we have been pushing to try and simplify that as much as possible.
When it comes to the supply chain for a lot of these materials, a lot of that is coming from China. How have the tariffs impacted your company?
So about 2 or 3 years ago, we completely reconfigured our supply chain. And most of our supply chain is actually in the US. So we use domestically made products, whether it's panels that are made in the US. We have a framework agreement, for example, with First Solar, batteries. So we tend to try to use as much as possible domestically made equipment. It is more expensive than if you import it. Although nowadays, with the uncertainty around the tariffs, we prefer to pay that premium, but ensure sort of a stable supply chain.
How feasible is this? Right now, China is dominating the solar, the wind, all renewable energies. Their battery plants have been far exceeding what the U.S. Production capacity has been. How much more expensive is it to source it domestically? How far behind are some of the technologies in the United States?
I think you have to separate what's the cost of the panels versus, let's say, then the additional tariffs or the additional costs on top of them. The underlying costs to produce them here in the U.S., maybe are 2 times what it would cost elsewhere. Then that can be compounded if you have sort of tariffs on top of that. But I think the key issue here is if you can increase the critical mass of the local production, of the national production, then you can hopefully bring those costs down over time. So I think building out that supply chain, I think you need to continue to invest in it to actually bring those costs down.
Is it harder to have a global footprint now?
You need to be more careful about where you are. I mean, energy infrastructure projects are typically very long dated, so we invest over 30 years. So we like to be in places, where rule of law is important, strong institutions where you can have that predictability over the long term. So we are, very focused on a couple of key countries. The US is one of them, where we really invest for the long term.
That's what I wanted to build on. Are you looking to narrow the scope of the countries that you're in?
So we were in about over 20 countries, almost 30 countries. We've been paring that down. We're going to be sort of closer to 15 countries, and we are exiting some of the non-core countries that either had less critical mass or that we didn't feel as comfortable in. So we're going to really focus more.
Where are you most comfortable at the moment making additional long-term investments?
Europe, US, some places in Southeast Asia, for example, Singapore. We like Australia, we like Japan. We have a big investment in Brazil, slightly different risk profile, but we're pretty comfortable there as well.
How much do you expect that to change over time, or this is sort of the new order as you see it? Are there countries that you no longer will participate in?
Well, I think it's been changing now, and I think our strategy has been to really keep a low risk profile. So I think, we certainly think that this will carry out over the next couple of years. We don't see this changing, if anything, only getting worse. We've been very careful about, or we see, I think, as does everyone, sort of the decoupling and some need for de-risking, and so we're following that strategy as well.
What do you have to say about the CTG and the biggest shareholder, 21% stake? What do you think they want to do with that stake?
I think they're an investor like many others. I mean, 80% of our investors are either U.S. institutions, Canadian pension funds. We have investors from the Middle East. We have investors from Europe. So hopefully they're a happy investor, and like all of our other investors.
Miguel, appreciate your time. Good luck for the rest of the week. Thanks
you.
for being here. Thank you, sir. Miguel Stilwell Dondrad, the CEO of EDP. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief, the latest worldwide with Yahara. Hey, Yahara.
Hi, John. Argentine assets surged after the U.S. pledged financial support for President Javier Milei. Treasury Secretary Scott Bessent said on X that all options were on the table to help arrest the run on the Argentine peso due to political uncertainty. Full details will likely only emerge after Milei meets President Trump at the UN General Assembly later today. Meanwhile, NATO is promising a robust response to repeated Russian airspace incursions. The military alliance says it will use all options to defend itself after Estonia said Russian jets violated its airspace last week. NATO is already strengthening its eastern flank with continuous air patrols under Operation Eastern Sentry. And week 3 of the NFL season wrapped up with the Detroit Lions defeating the Baltimore Ravens in a high-scoring thriller, 38-30. The Lions' rushing attack, led by David Montgomery and Jahmyr Gibbs, combined for over 200 yards and 4 touchdowns. The Lions also sacked Lamar Jackson 7 times, tying his career high. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next, Governor Myron making the case to go big.
In my opinion, it's imperative that we get closer to neutral quickly. And so I thought 3, sort of a series of 50s to recalibrate interest rates was the appropriate policy.
That conversation up next with Kristen Biddley of Citi, live from New York City. You're watching Bloomberg TV. The opening bell a few hours away. At the moment, equities are doing okay, just slightly negative on the S&P 500, closing at all-time highs in yesterday's session for a 28th time in 2025. The equity benchmark just a little bit lower, down by not even 0.1%, totally unchanged on the Nasdaq so far this morning. Under surveillance this morning, Governor Myron making the case to go big.
In my opinion, it's imperative that we get closer to neutral quickly. And so I thought 3, sort of a series of 50s to recalibrate interest rates was the appropriate policy. My view is that policy is roughly 2 points too restrictive. Even though I am expecting growth to be a little bit better in the future, that could get derailed unnecessarily so and create an output gap where one need not exist if we don't get policy closer to neutral.
So here's the latest this morning. Stephen Myron making the case for aggressively lowering interest rates to avoid damaging the economy. The newly minted Fed governor making the remarks in his first speech since joining the FOMC. Joining us now to discuss, the head of investment solutions at Citi, Kristen Biddley. Kristen, good morning.
Good morning. How are you?
Good to see you. It's been too long. We've got some rate cuts, or at least one so far. The prospect of more to come. What kind of activity is that unlocking for your clients, and what are you advocating for them to do at the moment?
I think for right now, this was largely anticipated and expected. So I think if we would have had any change, then there would have been changes in the portfolio. But for right now, we're sticking to our guns and staying fully invested. We're balanced across fixed income and equities with a quality bias and also leaning towards the U.S. market as well. And so for us, there's no real change unless we see a deterioration in the employment backdrop or unless we see inflation start to accelerate.
For people sitting in cash at the front end of the curve and looking at where Fed funds is, which is still north of the curve all the way out close to 10s at the moment,
yeah,
just below 10s at the moment or around that level, what are they saying to you about the incentive to go out along the curve? And what kind of argument can you make for them to get out of cash and put it elsewhere?
Yeah, it's a great question because when you look at cash is certainly building up on the sidelines, and I would say there's always that argument around the $7.6 trillion that's sitting on the sidelines, but quite candidly, that's only increasing. It's not decreasing. And so when you look at our portfolios, we're not advocating for long duration at all. I think you have to be weary of some inflationary pressures. So the average duration in our portfolios is around 5 years. I think that catalyst from going from cash into a 5-year duration, we have to be realistic about the investor psychology. So what we see more often is not your traditional 60-40 portfolio, but maybe a 60-30-10, where that cash position, people will hold it so they can be more nimble.
There is this issue of what's the best hedge against inflation? Couldn't it just be stocks? Isn't that almost what people are betting?
Yeah, I think it is. And I think there's actually a defensive play in terms of the largest free cash flow generating companies. And I know you guys have been discussing this all morning in terms of where should you be invested, particularly in equity markets. I think as an inflationary hedge, we have gold in our portfolios. I know many asset managers do as well. But when you look at where you want to be within U.S. equity markets, I think the major debate right now is, do we want to lean into momentum and the winners, or do we want to play this broadening out trade? I think the broadening out trade, while certainly it can deliver returns, I think it's still tricky because when you look at small caps, their earnings are declining. They're not growing. And then you look at these large companies, they've contributed over 60% of the earnings growth this year. So while it feels weird to be invested there, I think you have to play the momentum.
At the same time, as we were talking about this morning, the Nvidia OpenAI deal, the idea that Nvidia is investing $100 billion for OpenAI to buy their products. Exactly. So it creates this feeling that we're all hinging on this circular bet within big tech names that isn't yet getting ratified in the profitability in the rest of the economy. At what point does that feel wrong?
I think the main question is almost what is the bear case from here? And that's one of the questions. When we see all of this CapEx spending, when we see what is the timeline for that? When you will actually see the returns? And I think investors are patient. I think it's more, I saw a piece recently where it was innocent until proven guilty. And so looking out 1 to 3 years, I think there's patience in that investment. But I do think we have Q3 earnings coming up. And if there's one miss or if we don't have a beat and a raise, I think you will see a pullback in the market.
When you talk to clients, what are they most concerned about right now? You mentioned in your notes this tug of war between the AI story, but maybe even tariffs at some point hitting them next year. Are clients just dismissive, as Lisa Shallett said, of what's coming out of policy, or is it still in the back of their mind brewing?
I agree with Lisa in her comments. I think there's almost there's tariff fatigue. So it's almost that was the dominating conversation a couple of months ago, and now it's not really even a question that clients are asking. And so I think the major thing on investors' minds right now is really trying to position for the longer term, understanding that short term there could be some volatility, there could be some pressure one way or the other, but where are you positioned longer term, and really the balance between private and public markets.
Is that a cap-weighted US index? Is that how I position
think so.
for the long term still?
Still, I think when you look at, again, we're not in the camp of this broadening out trade right now. And so you could probably see some strong returns, particularly with interest rates coming down, and you don't want to fight the Fed on that. But I think when you look at the name of the game is really quality and free cash flow generation, and who's going to be able to make those types of, not $100 billion investments, but similar to really kind of fuel the growth.
Let's build on that. Why don't you like small caps? Had a great run off the back of the repricing of the Fed. Why is this just another head fake?
Because I don't think it's based on fundamentals. And so when you look at, okay, if there are inflationary pressures, if there's part of the market that is going to be exposed to tariffs ultimately, if there's part of the market that's not going to be able to do that CapEx spending, who's going to get left behind? It's smaller companies. So maybe through M&A, you could see some activity there, but I think this is really a market that's going to be driven by those making the investments and seeing the return on these investments.
The main argument has been the rate cutting cycle could potentially provide a boost to the rest of the economy in a way that some people weren't expecting. Has that all been priced in already? Or do you think that there could be some sort of upside surprise in the rest of the market as a result of potentially an even greater degree of dovishness in the Fed come after May of next year?
I think it's largely at this moment, if we're just looking from here to the end of the year, I think it's largely been priced in, especially for small caps. Again, these rallies that have been driven more not on fundamentals, but almost expecting that Fed momentum, I just see better opportunities in other parts of the market.
You pointed something out in your notes, and I love this, the idea that every single time that the Fed has been cutting rates at a time when the market's been at a record high, every single time, the 1 year out, the market was up and often up considerably. Why not just overweight risk right now?
So, great question. In our notes, basically what we shared was when the Fed, since 1980, has, with markets at all-time highs, the times that the Fed has started to cut rates, we've seen positive returns. We actually just saw that last year. So in September of 2024, we got a rate cut. We're now up about 17.5% since last September. So I think you still have to strike a balance, though, because what are the risks on the horizon? You don't want to be all in on equities in an environment where you still have, what are the risks? You basically have earnings and someone not delivering on earnings, and given that concentration, you could see some downward pressure. You also have the deficit, which is another major risk, and we have to talk about labor too. That when you look at the labor market, that is something that, well, we could say it's stalled, it is softening, and we're starting to see this emergence of why is the labor market stalling? Is it because of AI and people holding off? Is it because of tariffs? Is it because of immigration? There's really three cases there, but if we see the labor market continue to deteriorate, that's something that will ultimately impact consumer spending.
The labour market for grads is just awful, terrible. We've all seen the numbers. Does not look good at all.
Yeah, I mean, it's a personal issue. It's also something that very much speaks to the economy and the idea of upward mobility at a time when there are all these other pressures, cost of housing and the like. How much are companies truly replacing entry-level talent with AI? How much are they using that as a smokescreen simply because they don't feel very confident about the trajectory going forward?
Don't know, but I wonder if the much tighter restrictions around H-1B support or complement the effort to try and do something about the lack of employment right now for graduates in this country.
It's a good question, how much that really comes in parallel, and that's the reason why some people have supported more homegrown talent. I also wonder who's going to push back, get that lobbying engine back in Washington, D.C., and what exactly some of the carve-outs are going to look like.
That's all Washington, D.C. is, right?
Lobbying.
Just a big lobbying effort. Isn't that what it is?
And it's also one of those things where you could see a market that continues to grind higher, earnings continuing to go higher, and the unemployment rate going higher, which is something we haven't seen, but that is a reality.
Something to watch. Kristen, it's good to see you.
Good to see you too.
Thank you. Kristen Bidley there of Citi from New York City. The third hour of Bloomberg Surveillance is up next.
Fed's in a difficult position, but it's certainly taking a risk by lowering interest rates.
They have room to maneuver. They have room to come down some on the policy rate and still put downward pressure on inflation.
The flattening that we've seen is a bit of a buy the rumor, sell the news on the back of the Fed.
The Fed is cutting on risk management grounds into what may be the early stages of a cyclical reacceleration.
You kind of have the benefits of Fed cuts without the penalty.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your scores look like this. Following 3 days of gains on the S&P 500 and a 28th record high of the year so far. Equities pulling back by not even 1/10% on the S&P. On the Nasdaq, totally unchanged. In the bond market, 4 consecutive days of higher bond yields, now lower by a single basis point on 2s, down 2 or 3 on 10s to 411.96. Going into this speech later on this afternoon at 12:35 Eastern Time. the chairman of the Federal Reserve, Jay Powell.
The chairman for now. And how much will what he says actually give a guidance as to the Fed policy that will be followed? I'm just struck by right now what markets are saying. They're saying the Fed can cut rates, have a cutting cycle of 125 basis points more cuts by the end of next year without a reignition of inflation while allowing markets to go to record highs. It is essentially the soft landing that everyone was talking about without the landing part. And it raises a question of, is everything priced to perfection predicated on a very narrow path, or have we reached a place of stasis amid policy uncertainty where people don't care and are watching earnings go up and an economy chug along?
People are getting uncomfortable. And by people, I mean Lisa Shallard of Morgan Stanley, who was on the programme about an hour ago, comparing this to the late 90s and saying perhaps things are getting a little bit too sizzly.
The idea that maybe the biggest bull case right now is the absence of a bear case. People can't see what could disrupt this. The point that she made and that Kristen Bitterly made as well is that we're one bad earnings report away from a significant drawdown. And that, I think, is the key. How much are people hinging the entire positive outlook on the idea that these big tech giants can keep generating massive amounts of cash at a time when they are investing increasingly in each other, and companies are not showing the profitability to the degree that many people were hoping?
There's that angst, I get the sense, from these investors, given what Lisa Shallard said. One earnings miss is what could ruin it, not the policy uncertainty from Washington, not the Fed rate cut. And she said news headlines haven't been a catalyst. Markets have become almost dismissive of what the president said. He really set the tone in April when he backtracked. Now it feels like everyone's hinging on what the Fed's going to do, but more importantly, what is Nvidia going to report next quarter? That's the big driver.
November 19th. Got to wait a while. A few months before we get there.
I mean,
we're talking about this for a number of weeks, okay?
It basically is going to be 2026 when we get Nvidia's report.
I wish they'd move that. But
I
we've
think
made
that
that
they
argument a
should.
few times, you know? Let's bring it in.
Is it all them, or ultimately will it also come down to some smaller companies and how much they're actually using AI, whether they can monetize it or they're just investing it in little bots that talk to each other?
If Nvidia is investing in them, that'll be more important to hear from those companies in this new circular AI economy.
Going to get Ed Ludlow to fix this next time he speaks to Jensen. Coming up on the programme, we'll catch up with Liz Ann Sanders of Charles Schwab as stocks trade near all-time highs. We'll speak to Gil Luria of D.A. Davidson as Nvidia is betting big on OpenAI, and Stephen Stanley of Santander, with Fed Chair Jay Powell set to speak later on today. We begin this hour with Stock Steady. Liz Ann Sanders of Charles Schwab warning the market may be too top-heavy, writing the following: investors face a risk. The market breadth narrows and performance becomes overly dependent on a few dominant stocks. This dynamic can distort perceptions of market health. Liz Ann joins us now for more. Liz Ann, good morning.
Good morning, John.
Good to see you, and welcome to New York.
Thank you very much.
Thank you for coming in. Let's talk about that quote right there, and whether you believe we're becoming more or less dependent on just a handful of stocks at the moment.
We're becoming still very dependent on a smaller handful of stocks, though. So if you look at the cohort of the Magnificent Seven, just to pick a cohort as opposed to, say, the top 10, only 4 of those stocks now are outperforming the S&P 500. And the best among them, no surprise, Nvidia, is only the 47th best performing stock in the S&P 500, meaning 46 stocks within that index have better performance than Nvidia. Nvidia is the largest contributor to cap-weighted S&P gains, but it's not the best performer. The Mag 7 are all in the NASDAQ. Nvidia, as the number one performer among the Mag 7, is ranked, I think, 630th within the NASDAQ. So I think we're starting to see more dispersion even among these concentrated cohorts. You've also got correlation within the S&P has come down, dispersion widening out. So I actually think it's not a bad backdrop from a stock picker's perspective. It levels the playing field a little bit more for active relative to passive.
Let's build on that just a little bit more. So Kristen Bitterly of Citi was with us about 15 minutes ago, and she said for long-term investors, stick with the cap-weighted index. That's the way to go. What are the risks around that, given what you just said?
Well, you've got the concentration problem embedded in that index with the 10 largest names representing 40% of the index. That's an all-time high. Even the top 5 names represent close to 30% of the index. So you're certainly guaranteeing the cap-weighted return on the upside, but there's a downside to it. Now, memories tend to be short. All you have to do is look back to earlier this year, the mid-February to early April bear market in the case of the NASDAQ, near bear market in the case of the S&P, but many of those stocks were the drags on performance. So it does work in the other way. And we always say to our investors, pretty much all $11.2 trillion of our client assets are individual investors. And leaving aside the take a passive approach and index to the S&P, you don't have to take the same concentration risk. If you're an institution and you're benchmarked against the cap-weighted S&P on a quarterly basis, you are at the mercy of the construction of the indexes. But if you're an individual investor, you're not being benchmarked against the S&P on a quarterly basis. You can take more of a stock-picking approach and not take that risk of having such a concentrated portfolio.
Isn't that concentration a feature, not a bug? And I say this at a time when we're talking about the potential for an outperformance of the S&P 500 and the NASDAQ, even with a labor economy that is questionable right now.
Well, it's a feature in keeping the cap-weighted index returns high. But here's a stat. Just since the April 8th closing low, S&P has not even had a 2% drawdown over that period of time, continual record highs. But the average member within the S&P has had a 14% drawdown since April 8th. The average member within the NASDAQ has had a 32% drawdown just since April 8th. So there's a lot of churn and rotation under the surface. It's a feature in that all you need is a few mega cap stocks to bring those cap-weighted indexes. I just think the fuller story, not the real story, but the fuller story is told under the surface of these cap-weighted indexes.
John was mentioning Kristen Bitterly, who is just here, and she is talking about the cap-weighted and not necessarily the broadening out trade. She doesn't necessarily see that gaining traction. Do you disagree, based on the idea that you have seen this drawdown in the average stock outside of the Magnificent Seven, and that those companies potentially could be the most beneficially affected by a rate-cutting cycle that a lot of people are expecting?
Yeah, that's certainly the macro fundamental reason why small caps caught a bid, particularly given that the real surge was tied to Powell's Jackson Hole speech. I think one way to think about the broadening out, the fact that Russell 2000 finally hit a new all-time high, last time prior to this one had occurred was 2021, is I think staying up in quality still makes a lot of sense. And one piece of advice that we provide to investors, not to buy an index tracking, but if you use indexes as a source for ideas, Russell 2000 is still on the lower quality end of the spectrum, given that 40% of the stocks are some combination of non-profitable or zombie companies. Whereas the S&P uses a profitability filter in constructing their S&P 600. So it's inherently a higher quality index. And in fact, looking ahead, S&P 600 earnings outlook versus S&P 500 earnings outlook, the former has a much better trajectory, mid to high 20% range in terms of 2026 earnings versus more in the kind of mid-teens for the S&P 500.
How correlated is the Russell, these small caps to do well, with how quickly the Fed continues on a cutting cycle?
That, I think, would be a risk that the outperformance trend does not persist, is if the Fed has to cut short the cutting cycle, not dissimilar to what happened last fall. The one thing that's interesting is we've seen that edging up on the part of the long end, very much in keeping with what happened last year when the Fed cut by 100 bips and the 10-year went up by the same amount. Mortgage rates went up by 80 basis points.
When you mention these cap-weighted indexes, they're so sector-focused and concentrated. So isn't it doing the opposite of what investors want? Where are people diversifying?
Again, I think the active approach, I think there's a reason why active ETFs, the growth rate in active ETFs is higher than the growth rate in passive ETFs. Now, part of the reason why it's a higher growth rate is it's coming off a lower base because passive ETFs have been much more popular. But I think that is a bit of a tell that there are investors looking for opportunities outside of just the cap dominance within these cap-weighted indexes.
Does this feel bubbly to you? You've seen it all. Let's finish there.
I have seen it all.
How does it feel?
Almost 40 years doing this. I'd say that the big difference, probably the most important difference between now and the late 1990s, is there's more there in terms of massive cash flow generation. There's actually a denominator in the valuation equation now. There was no denominator in the valuation equation. I mean, we all look now through the benefit of hindsight and say, boy, was that just so silly. And, the attaching of .com to companies that had nothing to do with that. So there is more there. But again, going back to that period just this year, mid-February to early April, when you had the DeepSeek news and concern about whether the massive amount of spend was indeed a protective moat built around these hyperscalers, I think that we can go through valuation adjustments, necessary valuation adjustments, or even just periods where you get about a profit taking that is distinguished from what ultimately happened in 99, 2000. I think it's a right tail risk for the market, maybe with similar probability as what would be the left tail risk, which I think the left tail risk is a recession, which I don't think is priced into the market. But these are much higher quality companies than was the case in the late 90s.
I just sense the discomfort from a lot of people with some of the recent announcements, whether it was Oracle in the last few weeks or this one from Nvidia to OpenAI. They will look back in a few years and they're worried about feeling foolish, looking back and thinking, well, wasn't it obvious? This company came out, invested this money so this other company could buy their stuff. Like, shouldn't we look at that and say that doesn't make sense? That's a house of cards.
Shouldn't we look at the fact that NVIDIA's customers are almost entirely the hyperscalers, almost entirely the Microsofts and the Alphabets and the Oracles, and this idea that it is a sort of closed cycle, and we're not seeing it in the broader economy. And you add on top of that the sense that almost everyone is saying up, up, and more up, and they're upgrading the forecast. It's making people uncomfortable, but that discomfort can prolong the cycle, and that, I think, is what key people keep saying.
And they're the companies making money.
Exactly.
To Lizanne's point, there is some there. Lizanne, it's good to see you here. Thanks for being here. Lizanne Summers at Charles Schwab, thank you. Thank you very much. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to Yahara for more. Hey, Yahara.
Hi, John. We start with that massive AI deal. Nvidia is set to invest as much as $100 billion in OpenAI to support new data centers and other AI infrastructure. The agreement will help OpenAI build the data centers using Nvidia's advanced AI chips. The investment will be provided in stages with an initial $10 billion. Nvidia shares popped nearly 4% yesterday on the news to close at a record high. Meanwhile, the Trump administration has linked Tylenol to autism, urging pregnant women to avoid it. The move comes despite a lack of widely accepted scientific evidence supporting the risks. Still, the FDA recommended doctors consider minimizing the pain medication for low-grade fevers, while noting a causal relationship between autism and Tylenol has not been established. And the U.S. Secret Service says it interrupted a network of devices that could have severely disrupted cellular service in New York. Authorities say the SIM cards and SIM servers were used to threaten senior U.S. government officials, while world leaders gather here for the UN General Assembly. The Secret Service says it bore signs of foreign involvement. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. More from Yahara about 30 minutes from now. Up next on the programme, the Morning Calls, plus Gil Luria of D.A. Davidson as Nvidia is betting big on OpenAI. From New York City this morning, good morning.
The key driver of this bull market has been AI and tech, and the key driver for the overall market has been those earnings from these companies. Does it raise some, eyebrows a little bit? Sure, but in the near term, I think this means that earnings continue to move up, and that continues to support this tech trade and the overall market.
That was Keith Lerner of Truist sticking with it in the equity market following 3 days of gains. It's a quiet market so far this morning. Futures going nowhere on the S&P 500. Likewise on the NASDAQ. Things get a little busier in about an hour and 30 minutes when we get some US PMI data for you. A read on the start of September. I think that's important coming out of the summer. Are we actually seeing a pickup in the US economy? It's what the market is priced for. It's what many companies are guiding for.
Yeah, and how much can manufacturing play a part in this? This is sort of underpinning a lot of the hopes and dreams of the resurrection of the U.S. economy, as it's going to be with greater degree of manufacturing, and we have seen that. Do you see the PMIs confirm that after what we saw in Europe? Again, this goes to this question of, is the reacceleration just a U.S. story, or is it international?
And then after the PMIs, you'll hear from Chairman Powell. That's the main event for the Fed speak later on this afternoon at 12:35 Eastern Time. In the bond market at the moment, in anticipation of that, following 4 days of high yield, a little bit lower across the curve this morning. 2s out to 30s. The 2-year down by a basis point. The 10-year down by a little bit more than that. The yield on a 10-year maturity this morning at about 4.13. That's the price action. Let's get you some morning calls. First up, Wells Fargo upgrading CoreWeave to overweight, saying demand signals are too strong to ignore. Their stock is up by 1.6%. Your second call from Morgan Stanley, raising its price target on Oracle to 320, expecting fundamental changes in its revenue growth from massive contracts. That stock is down about 1% this morning. Big rally to start the week for that name. And finally, Evercore raising its price target on Nvidia to $225, following its deal with OpenAI, seeing Nvidia as uniquely positioned to help OpenAI with its infrastructure build-out. Let's stick with Nvidia and their story. Gil Luria of D.A. Davidson maintaining his buy rating, but has some worries following the deal. Gil writes the following: "While the announcement is positive for OpenAI's ability to ramp, we're concerned Nvidia has become the investor of last resort, bailing out OpenAI's overextended commitments." Gil joins us now for more. Gil, welcome to the program, sir. I'd love your perspective on this. Just how uncomfortable are you following that deal announcement, and why?
We are uncomfortable because if the market really was as good as Nvidia and OpenAI said yesterday, there would be other capital available to OpenAI as opposed to the vendor that's supplying the AI trade. We really need to start separating what's real, what's healthy from what's unhealthy. And you had a great discussion so far this morning about this. Let's talk about what's healthy. Microsoft, Amazon, Google are healthy. They have the real customers and they have the capital to invest in new data centers to provide AI. AI, the models are fantastic. They are doing things we never imagined they could do, and they keep getting better. People are using them for more things. They're bringing them to work. That is very real. On the other hand, we have companies like OpenAI making commitments that there's no way they can live up to. Let's not forget, Microsoft has right of first refusal for all of OpenAI's compute, so they're going to handle most of it. OpenAI just committed $300 billion of compute commitments to Oracle, another $100 billion to Beka, another $25 billion to CoreWeave, and then signed up for projects in the UK and the Gulf. They don't have that capital. They're on a $12 billion revenue run rate, and they're going to lose probably $10 or $20 billion this year. They're building hardware. They're building a consumer product. That is not real. So you have to be careful about the marginal trades here. Interesting talking about CoreWeave and Oracle upgrades. Those are the marginal players. Those companies have neither customers nor capital. Unlike Microsoft, Amazon, Google that have both, they're just dumping them over the excess demand onto CoreWeave and Oracle. As soon as they have enough of the capacity they need, they won't need those marginal players. Those marginal players are the bubble.
Gil, this to me is fascinating. I'd love to unpack that, this idea of all of the commitments that OpenAI is promising. What actually are they promising as part of those commitments? I mean, you could make the argument they could be the next Alphabet, right? That they could really compete with Google in a material way, and then that could be worth it in terms of their valuation and some of their software provisions, as well as their algorithms. Where do you see the disconnect in what they're actually offering?
So the operative word in what you just said is could. Unlike Google that ran away with search, OpenAI is in a very competitive market. We don't know that they're going to have the winning solution. They have a lead now, but so did Yahoo and so did MySpace. What we know is that Google has models that are just as good, if not better, than OpenAI's. Anthropic, for certain things, has models that are just as good as better. We know Zuckerberg is investing tens, hundreds of billions of dollars at building a different model. We know there's Chinese models. OpenAI is not going to run away with it. They have a lead. They may participate, but the likelihood that they'll run away with it and need $500 billion of compute over the next 5 years is pretty far-fetched.
Given some of the commitments that you've been talking about, the $300 billion to Oracle, the $100 billion investment announced overnight, you start adding this all up, it's real money. I just wonder, Gil, at what point, if you see an OpenAI show its vulnerability, how much that disrupts the larger ecosystem in a real material way from a valuation perspective and beyond?
Yeah, it'll cause disruption. Again, I would be weary of the marginal players here, because they're going to be the ones that get hit the worst. Nvidia will keep selling chips. Microsoft will continue providing services to its customers. So will Amazon Web Services, so will Google Cloud. But I'd be weary of all the incremental marginal trades on AI that are really getting out of control right now. Nvidia is the most attractive direct bet on AI right now. That's why we moved to buy, because at 28 times earnings, they're trading at a lower multiple than any of those marginal players, in spite of the fact that they're going to win one way or another. Whether they sell chips just to Microsoft, Amazon, or Google, or to more companies beyond that, isn't as important. The demand for data centers is there because AI is potent. Just be aware of where you're investing in that.
Well, last week we saw Nvidia take an investment in Intel. This week it's OpenAI. Who's going to be next?
Well, so in a different world, Nvidia would be buying a lot of these companies, but we are in a world where the big techs cannot make acquisitions. So they're going to have to make these types of investments, acqui-hires, et cetera. Now, Intel is a little bit of a different matter. Intel is a strategic investment in the ability to move the supply chain to the United States after the US government stepped in and said that they will ensure that would happen. That facilitated Nvidia coming in and saying, you know what, we are going to put Intel into our ecosystem, make sure they have a viable customer so they can ramp up their 14A technology. We'll bring them into the data center, which is a little ironic considering Nvidia is the one that wiped the floor with Intel for so many years in the data center market. Now that they've defeated Intel, they can bring them back in as a marginal player.
Gil, I've got 45 seconds. It sounds like the company you really have an issue with right now is Oracle and the move we've seen so far this month. Can I just give you 45 seconds just to explain what is your problem with that move this month?
That $400 billion of Oracle's market cap is tied to one company, OpenAI, that has made commitments that there is no way it can live up to. So if that much of your market cap is tied to one commitment that really is untenable for all the reasons we just discussed, maybe that's a little too much. It's been how they've expended their remaining performance obligations from 80 billion to 455. The vast majority of that is OpenAI. That is the entire move on Oracle's stock. I would revisit that calculation.
Gil, it's your opinion. We appreciate hearing it. Thank you, sir. Gil Lurie there of D.A. Davidson. Thank you, sir. The latest on Oracle and some of the big moves we've seen this month alone.
Larry Ellison, if you want to call in, please go ahead. I'd love your rebuttal to that because I think it's actually a salient point.
NASDAQ futures this morning just about unchanged, very close to all-time highs. Up next, Stephen Stanley of Santander with Fed Chair Jay Powell set to speak later on today. We are 60 minutes out from the opening bell, and equity futures are only slightly negative on the S&P, just pulling back from all-time highs on the S&P 500. With your morning movers, your single names, here's Danny Berger. Hey, Danny.
Hey, John. One of the best performing stocks in the S&P 500 pre-market is Boeing this morning, up 2.4% after the U.S. ambassador to China, David Perdue, said that there was a huge order in the works of Boeing aircrafts by China to Boeing. Bloomberg has reported in the past that China has been working on a 500 aircraft order from Boeing, so that could be what indeed the ambassador is talking about. Elsewhere this morning, a little bit of deal news breaking in the past hour. Sempra, the energy infrastructure company, in one of its energy infrastructure portfolios, it will be selling about 45% of it to affiliates of KKR and the Canadian Pension Plan. That deal will net them about $10 billion. They'll get that in cash equity, 47% of which at the close. The next bit comes through the year 2027. Finally, wrapping things up with some earnings we got this morning. That was from AutoZone, the auto retailer. Shares down 3.3%. It was the fifth consecutive earnings that they missed. Even with that miss, though, the CEO saying that they're doubling down, opening more physical U.S. stores, but margins missed and their inventories were higher. So all in all, a negative report for them, John.
Danny, thank you. A few names to look at going into the opening bell. The opening bell 60 minutes away. 15 minutes after opening bell, some important economic data, the US PMIs at 9:45 Eastern time. Then later on this afternoon, capping off a busy day of Fed speak, we'll hear from Fed Chair Jay Powell speaking just afternoon at 12:35 Eastern time. With the preview, let's cross over to Mike McKee for more. Good morning, Mike.
Good morning, John. Well, I'm not sure we're going to get a whole lot out of Jay Powell today that we don't already know, because he just spoke a week ago after the Fed meeting, and he said the Fed is at this point concerned about the labor market and considering cutting rates again, but check with us as we get closer to the date, which would be October 29th, because we want to see more data and see how the economy develops. What might be more interesting today is Mickey Bowman's speech. You had her up there on that graphic. She speaks at 9 o'clock in the morning, and she was perhaps the person on the board closest to Stephen Myron's views. Does she agree with him that the neutral rate has fallen significantly and the Fed needs to play catch up and cut rates a lot going forward? Does she have an estimate for the neutral rate? And how much does she agree with Myron's outlook going forward? Powell has said over and over again that we shouldn't make policy by using the neutral rate because you can't really observe it. So he's probably going to be talking much more about the data and the data dependency the Fed has been on, which, of course, is somewhat backward looking. So doesn't look like we're going to have anybody solving the debate this time. It just looks like we're divided, and we're going to continue that for some time.
Michael, have we got any reporting whatsoever on just how well received or not Governor Myron's argument was on the committee last week?
It's about the same that we've been reporting all along, that people give him credit for being a decent economist and for making plausible arguments, but they don't really believe what he's saying. There are people, Bowman, who might be one of them, who would say that, yes, we probably need to do more sooner. But in general, the majority on the Fed is at this point in a watch and wait mode, willing to cut rates, but wanting evidence that they need to do so.
Mike, thank you, sir. Michael McKee. Look out for Governor Bowman later on this morning. Let's stick with the Federal Reserve. Stephen Stanley of Santander writing, Chairman Powell seems frightened that the economy could be on the cusp of a surge in layoffs. But while new hiring has slowed dramatically, layoffs are not picking up. Stephen joins us now for more. Stephen, good morning.
Morning.
Do you think rates pricing is too aggressive?
I would say it is. I mean, I think it's not outrageous for the rest of this year, but there's a lot of easing also priced in for 2026.
Why do you think the labor market is more solid than it currently appears, especially given some of the revisions in non-farm payrolls?
Yeah. So I would say a couple of things. The first one is I think that a lot of the slowdown in job growth is a reflection of changes that we've seen on the supply side of the equation, right? Just the slowdown in immigration. We haven't seen a dramatic slackening in things. I mean, the unemployment rate has ticked up a little bit, but it's still pretty close to where it's been for the last year and a half. I think the other point I would make, and I think this is the more important point, is that you have to think about why is the labor market slowing down. And when you listen to what companies are saying, they're not saying, oh, you know, we're getting ready for a recession, we're about to lay off a bunch of people. They're saying, we've put ourselves on hold for a few months, we're waiting for policy certainty, and once we have that certainty, we're going to reengage. And I thought it was interesting that we heard from a couple of Fed Bank presidents yesterday suggesting that maybe firms are just getting to that point where they're almost ready to reengage because we have seen a lot of the policy uncertainty resolved at this point.
I think a big question is, what does reengage mean? Does it mean invest in a bot that can talk to another bot that can then talk to another bot to tell it what to do and then a robot will fulfill the order, or will it be actually hiring people? Could you see a scenario where you get a reacceleration in the U.S. economy without the labor market getting materially more robust?
Well, it certainly depends on what sectors of the economy are driving you, right? I mean, if you're talking about just purely a manufacturing revival, then that's not going to generate a ton of jobs. Service sector is still very labor intensive, so I think most parts of the service sector, if they're strong, there you'll see a good amount of hiring.
To Lisa's point, though, how much are companies just saying policy uncertainty as an excuse for AI taking entry-level jobs?
I think we are seeing places where AI is having a big impact. I think that, you know, there's been a lot of talk recently, I've written about this, the weakness in the market for recent college grads. And I think that's certainly, at least in some industries, one place where AI may be taking away from what would normally be demand for workers. But, you know, we've seen, you know, you can go back 200 years, right? We were an agricultural economy, and then we moved forward to a manufacturing economy and a service economy. Some would say now we're moving to an information economy. Technology is always eliminating certain types of jobs, but in the process, it has always in the past generated new jobs. So you can't always predict what those new jobs are going to be. I'm not, on an aggregate level, I'm not worried that we're not going to have enough jobs for people, but I do think there's going to be definitely some shifting around in the market.
How does the Fed discuss that? Because they don't have a prescription for AI's impact on the labor market.
No, the Fed can't really, that's something the Fed can't really control, right? So the Fed has to stick to its knitting. We have to keep inflation close to 2%, and keep the labor market close to full employment. When there are supply side shocks to the real economy that are beyond the Fed's control, that makes the Fed's job harder, for sure.
Bit of a guessing game, but where have you got neutral? Where do you think it is?
Yeah, I have more sympathy for the high neutral camp.
Okay.
So I maybe 3.25 to 3.5, somewhere in that range. And the reason I would make that argument is that the economy has, by and large, performed very well over the last few years. I mean, if you remember, at the beginning of 2022, the funds rate is at 0. Market participants never had the funds rate getting back above 2%. And the idea was if you got to 2% or higher, the economy would fall apart, we'd have a recession, the government couldn't fund itself. There were all these dire things that were going to happen. And here we are. We had over a year at over 5%. We've had over a year at 4%. The economy's done pretty well. And by the way, financial conditions are tremendously positive at this point. So it just doesn't feel like the Fed is grossly restrictive at the current rate level.
I can tell you, just to echo that, I remember in 21 being on a call with Bill Dudley and Mohammed Al-Arian, and at the time they were talking about the prospect of getting rates back to 5. Maybe we'd have to go back to 5. I remember just being in shock thinking, if we go back to 5, what would happen to markets? What would happen to the bond market? And here we are. Yet here we are. And Governor Myron's saying we're 2 percentage points too tight. Now, for an individual yourself who believes that maybe market pricing is too aggressive for 26, I want to understand how you'd respond if an incoming Fed chair, someone nominated and confirmed, said the same thing that Governor Myron said this week, that monetary policy was roughly 2 percentage points too tight. How would you respond to that? How would you start to think about and recalibrate your expectations for next year?
Yeah, I mean, I think that there's two issues there. One is how much sway does one person have, even the chair? And I think the answer to that is if someone comes in who is grossly out of line with the consensus, I think it will be very hard to drag everybody along. So I think that a super dovish chair would have some influence on the path of policy, but not just going to come in and get their way. And then the second point is how aggressive would the Fed be in that sort of an environment? Would it be, let's jump first and ask questions later, or are we going to kind of take things as they come and we're only going to move as the data dictate, right? And as long as inflation is closer to 3% than to 2%, I think you're going to see a lot of caution on the committee. And we heard that yesterday out of some of the more hawkish members on the committee, Hammack and Bostic and
Muslim as well, right?
Yeah.
But caution, but that isn't preventing them from cutting rates. And that the baseline right now is priced into markets. You started by saying you think it's actually pricing in too many rate cuts, and you think that there actually will be fewer. Let's say they do cut by an additional 125 basis points, and that the baseline of the committee does see neutral at a lower level than you do. How much greater is the risk of true reacceleration in inflation next year? How underpriced is that possibility?
Yeah. I think it's a risk. I don't think it's a baseline scenario for sure. As we talked about with the labor market, I mean, in my mind, it's not a disaster, but it's certainly less overheated. If it's overheated at all, it's much different than it was, say, 2 years ago. I don't see we've got the tariff impacts that still have to flow through, and you can imagine a scenario in which tariff-related price hikes kind of kick off something bigger. I don't think that that's a high probability scenario, but it's a possibility. It's something the Fed wants to guard against and something they've talked about a lot. I don't think that we should be, just pulling our hair out that inflation is about to take off again. But at the same time, inflation has proven to be stubbornly high. And I think the Fed needs to, in my view at least, needs to take that into account and be cautious in moving rates down. The closer you get to the Fed's view of neutral, I think the higher the bar is going to be for cutting again. And you heard that a little bit yesterday. It's like, okay, I was willing to go along with last week's move, but I'm not sure I'm going to go along with another one. And then there'll be others who will say, well, I could go for one more, but I don't know about two more. You look at the range of longer run dots that we got last Wednesday. There are 19 people in the FOMC. There were 11 different answers for where neutral is, ranging from 2 5/8 to 3 7/8, right? So as you start to get into that zone, more people are going to get uncomfortable if you keep cutting.
We're getting closer to that zone.
We are.
Every meeting between now and May gets a whole lot harder potentially and not easier. Stephen, appreciate your time. Thanks for being here. Thank you. Stephen Stanley there of Santander with an update on stories elsewhere this morning with your Bloomberg Brief. Back with us, here's Yahira. Hey, Yahira.
Hi, John. U.S. President Donald Trump is in New York to address the UN General Assembly later today at 9:50 a.m. Eastern. Trump is scheduled for high-stakes bilateral talks with leaders from Ukraine and the EU, as well as a multilateral meeting on post-war governance in Gaza with leaders from the Middle East and beyond. In an interview with Times of India, JP Morgan CEO Jamie Dimon says he hopes President Trump and Indian Prime Minister Narendra Modi can reach a trade deal. Plus, when asked about the Trump administration's steep hike on H-1B visa fees, Dimon said he will be engaging with stakeholders and policymakers, adding that the move, quote, came out of the blue. And Hong Kong has issued its third highest storm warning as Super Typhoon Ragasa approaches after lashing the Philippines, as you can see there. It is equivalent to a Category 4 hurricane, according to the local weather agency, and has caused major flight disruptions, closed schools and businesses. It could potentially be the most damaging storm in the region since 2018. That's your Bloomberg Brief. John?
Yahira, thank you. Thanks for this morning. Up next, we'll set you up for the day ahead. Plus, we'll catch up with David Rubenstein of the Carlyle Group, live from New York City this morning. Good morning. You're watching Bloomberg TV. The opening bow is about 43 minutes away. Going into that opening bow, equity futures totally unchanged on the S&P. Likewise on the Nasdaq 100, on the Russell, on the small caps, up by 0.2. In the bond market, yields lower by a single basis point on a 2-year bond this morning, 3.59 on 10s, 4.13. Yields down about a basis point. Around an hour from now, the focus on the economic data. Talked loads about the Fed speak. Can we just talk about the data? I think these PMIs are important to get a flavour of how things started to build coming out of the summer.
Yeah, especially because European PMIs came out stronger than expected, and substantially so. At a certain point, are we seeing the reacceleration? Is it global? Is the U.S. the epicenter of it, or is it not? And I think that that's sort of an interesting question, especially when you look at the currency and then gold, and then you wonder what's going on there.
The gold rocketing.
Yeah, exactly.
40% plus move year to date.
Bonkers.
Amazing.
It is. I mean, and how much does it continue, given the fact that central banks continue their investments?
Let's get you a sneak peek of the next week, including what you can look for today at 9:45 Eastern Time. As I said, PMI data coming out. Then just after that, President Trump speaking at the UN General Assembly. Later on this afternoon, comments from Fed Chair Jay Powell. On Wednesday, Fed President Mary Daly is speaking. On Thursday, another round of jobless claims. Plus, we get some results from Costco. Finally, PCE data to round out the week on Friday. Going into the weekend. Before we get to the weekend, make sure to watch the latest episode of Bloomberg Wealth at 9 p.m. Eastern Time as David Rubenstein sits down with Wellington Management CEO Gene Hines. David Rubenstein, the co-chairman of the Carlyle Group and host of Bloomberg Wealth, joins us now for more. David, welcome to the program, sir. We've got a range of topics to work through. First of all, given the Federal Reserve and Chair Jay Powell is in focus later on this afternoon, a man who, of course, you know well, we'd love your reaction to the latest pressure on the Federal Reserve and the daylight, the division within the committee right now, and the daylight between Governor Myron coming out of the White House and everybody else. David, what's your reaction to that as it builds through the summer and as we enter the fall?
Well, the Fed did what most people thought it was going to do, which is to have a rate cut of 25 basis points. President Trump didn't applaud that. He didn't criticize it either. I presume he wanted a bigger rate cut, but generally he was okay with it based on what I've heard. But I think he would like more rate cuts. Whether the Fed will do more, time will tell. Jay Powell likes to look at the data, and I think he got enough favorable attention for the 25 basis point rate cut, such that he's not under pressure immediately to go do another 25 right away. But I suspect when the Fed meets again, another 25 basis cut would probably be on the table. Whether it will happen or not, I don't know. Depends on who's on the Fed, of course. As you know, there is Supreme Court litigation about who's on the Fed right now, and we just don't know who's actually going to be on the rate-cutting committee when the next Fed meeting occurs.
David, how closely are you tracking the replacement, the process to replace Fed Chair Jay Powell, and how credible do you think that process is?
I think the president has largely made up his mind. I obviously can't speak for the president, and I haven't talked to him about it, but I suspect that there are very few people that he is considering at this point. He knows all the people who are likely to be candidates pretty well, and I think it's down to one or two people, but I think he probably has made up his mind, would be my guess. I don't really know for sure. And I think those are people who are likely to do pretty much what he's interested in doing. So I don't think he's looking for any surprises by picking somebody he doesn't really know.
David, you're in a wonderful
position. Jay Powell's term is not up until May, and Jay's made it very clear that he wants to stay through the end of that term, which is May of 26, and then he'll be gone, and then you'll have a new chairman. Presumably that person will be confirmed before Jay Powell actually leaves.
One of the questions for the Federal Reserve, as well as economists more broadly, is just whether this economy is truly reaccelerating or whether we are facing something that is more pernicious, particularly led by the labor market. Based on your position, the hat that you wear at the Carlyle Group and the portfolio companies, are you seeing more signs of reacceleration? Or are you seeing more signs of something that's more tepid?
The biggest surprise to date is that the impact of the tariffs has not yet been felt in the economy in any meaningful way. When tariffs were imposed, people thought this would produce runaway inflation. It hasn't happened yet. That's in part because the tariffs haven't gone fully into effect, and in part because I think some of the U.S. importers are not passing along the costs. But probably it will take us 6 months or maybe even a year before we know the true impact of the tariffs. One thing I would like to point out, though, is the tariffs, whether you like them or not, are now going to be part of our economic system. And this is what I mean. When the big, beautiful bill passed the Congress, it assumed over the next 10 years or so we'd have roughly additional $2.2 trillion of federal indebtedness, $2.2 trillion over 10 years. But that assumed about $4 trillion of tariff income coming in. So if the tariffs were to go away, as some people would like them to be going away, you're going to have another $4 trillion of additional federal indebtedness. So we're in a difficult position. If you don't like the tariffs, you've got to come up with some other way to get $4 trillion of revenue into the system where you're going to have a gigantic increase in the debt.
David, you were talking about how this is a different system, right, where tariffs are a part of it. We also are talking, we've talked a lot about how the government has taken a stake in Intel, had a more direct influence over a number of different technology companies. When you talk to the heads of wealth, for you yourself at Carlyle, how much is it difficult to really adjust or change the way that you invest around some of these changed policy perspectives?
I don't think it's really changed that much because right now, most things that people like Carlyle or Blackstone or Apollo or KKR are investing in are not directly affected by what the president is doing. There are a couple of very visible deals that the president has taken, or on behalf of the U.S. government, some stakes in or had some modifications on the deal that was on the table. But generally, I don't think it's had a big impact. Right now, the investing world is in reasonably good shape. Inflation is not a gigantic problem at the moment. U.S. growth seems to be in reasonable shape. Clearly, there are always some challenges in the economy. I think most investors would like to have more certainty about where the Fed is going in terms of interest rates. But generally, I don't think people are holding back on doing deals at the moment. In terms of the stakes that the federal government's taking, presumably they will all be put in some kind of sovereign wealth fund or something of that type at some point. The U.S. government doesn't have a sovereign wealth fund. In effect, our sovereign wealth fund over the years has been our printing press because we've, in effect, been able to print all the dollars we really needed and, in effect, substitute that for a sovereign wealth fund. But I think the president seems to be interested in developing a sovereign wealth fund, and the Secretary of Treasury and others have talked about it. And presumably some of the stakes, like the Intel stake and others, will ultimately go into some kind of sovereign wealth fund.
David, if I could just quickly pick up on that comment you made earlier about Jay Powell will be gone. His governorship ends in 2028. This is someone you know really well. Do you think he will leave after he's no longer chair, or do you think he's going to stick around?
I don't want to speak for him, but my guess is that he will follow the pattern of every other chairman of the Federal Reserve, which is when their chairmanship is over, they depart from the Federal Reserve. Yes, he could theoretically stay longer, but once you've been the chairman of an organization for a long time, it's very difficult to stay around as a regular board member. So no, I believe, but I don't want to be making news about it, but I believe, based on everything I know, that he will step down as chair and step down as a board member when his term as chair is over.
David, you've been generous with your time. Thanks for your time this morning. David Rubenstein there of the Carlyle Group on the Federal Reserve and a whole lot more.
You know, his comments on the sovereign wealth fund were very interesting. The idea that the Intel stake and some others could end up in a sovereign wealth fund that we don't yet have. And that so far the sovereign wealth fund has essentially been the dollar and the printing press, and how much that's going to shift to real investments in companies. That's something I want to wrap my head around a little.
We've asked the administration this. I've been in the room, and they say that that's not really the direction of travel right now. But David is right. There's been tons of speculation around this, and potentially this is what they are trying to do. When it comes to Jay Powell, he didn't want to make news, but Powell has yet to tell the administration he's leaving.
I know.
And this is where some of the angst is right now when it comes to Treasury Secretary and the president and how they're thinking about the Fed next year.
They want to put the chess pieces in certain places. Still trying to work out if there is a free place when Chairman Powell finishes his term as Fed chair in May.
Yeah, and I wonder why he isn't going to commit to that essentially right now. He's focused on the current ahead. He's not going to mention this later today.
It's going to be a conversation for the new year, I imagine. Going to wait until then. We'll see. Coming up tomorrow, here's the lineup for you. Peter Cheer of Academy Securities, Neil Dutta of Renmac, Barbara Reinhardt of Voya Investment Management, and Nathan Sheets of Citi. The chairman of the Federal Reserve coming up a little bit later, 12:35 Eastern Time. Look out for that from New York City. You're watching Bloomberg TV.